important because once you tokenize all these assets, you bring liquidity where there was none. I'll give you an example. Tokenization of real estate. Real estate is an illiquid asset. But what if I now tokenize it and I can create a market where you can trade the tokens and therefore you can achieve higher levels of liquidity and you can allow people that didn't have the ability to own real estate to now buy into these tokens that are traded real time in an immutable ledger with all the controls and all the liquidity, and therefore they can enjoy the increasing value of these tokens that they were excluded from the financial markets. And of course, it's programmable. Remember, you can say to the tokens, for example, if you now have tokens of shares, you know how many people in the markets work just to do reconciliations to determine who should be paid a dividend? That will disappear. Why? Because the smart contract will know exactly who to pay the dividends on the payment date. And then finally, because it's recorded in the ledger that I just explained, the blockchain, it will be an immutable proof of ownership. At any point in time, you will know that this is for real, that there's value in it, and that the records are transparent. I have to tell you that it took 7 years for the financial markets to reconcile the Lehman books and records because they couldn't really know what was the exposure of Lehman around the world. And that's why Lehman went under. Imagine that now you're going to have this real-time record all the time, and therefore you will never have any doubts as to what the liability of a company and the exposure to risk is. And therefore that will make auditing and supervision of financial markets much simpler. So what we are seeing in terms of the tokenization roadmap, I have to say, I work for the biggest blockchain company in the world called ConsenSys, and all our clients have started to tokenize what's illiquid. So we started with property, private equities, SMEs, art, racehorses, container ships. Now, I must say, we are really very engrossed into the semi-liquid assets, which is hedge funds and listed small, medium enterprise, and therefore also debt. The last thing we're going to be commoditizing, tokenizing is liquid shares. Why? Because it's at the moment, the stock markets are protected by certain legislation. But as we evolve and we work with the regulators, we know that that legislation will accommodate the blockchain and will take away a lot of the legislation that is protecting the current monopolies. So why is that changing? Why are the stock exchanges that don't change going to be under threat? Look at the left-hand side of the transparency. This is what happens in today's financial markets. The investor that wants to buy shares can never talk to the investor that wants to sell the shares. It has to go through a broker, a clearinghouse, a custodian bank, a central depository, a settlement house, a stock exchange, all these intermediaries. And this, in South Africa, it takes 3 days from the time you trade until the time you get settlement. In the New World Order, peer-to-peer, you will put an order to buy a token and you will settle real time in peer-to-peer. Can you see already how this is a massive game changer? So, can you see why security tokens, for example, have got this incredible benefit? First, no working hours, no public holidays, not phoning any intermediaries. It works all the time. Then you can achieve fractional ownership. Can you picture how unit trust, mutual funds, that industry will completely be disrupted, because who wants all these intermediaries in the mutual fund industry when you can actually tokenize a portfolio of shares real time and sell it directly to the investor? And then immediate settlement increases liquidity and market depth. Incredible flexibility of the programmability of the smart contracts. As I explained, the compliance can be automated, total reduction in direct costs, because once you eliminate all these intermediaries, and remember, the one thing I haven't told you, the infrastructure that is used for this technology is the internet. The infrastructure that is being used in the current plumbing of financial markets is mainframes, Swift messages. The stock exchange is even using this technology that was invented 30 years ago and is still working, but hardly, and it's very expensive to operate. So all of that has to go, like the horses lift and got replaced by the car. This is what we're bringing into the market. We're bringing a car, not a faster horse. And the most powerful thing I have to say is that all these tokens will start to achieve interoperability. Then everybody's very keen to understand cryptocurrencies, when to buy, when to sell. That's why we're attending this conference. But I'm glad that I've been invited to explain blockchain. Why? Because cryptocurrency derives the certainty because there's a ledger that records this information in the way I just described. You cannot have cryptocurrencies without blockchain because blockchain is the record that keeps the certainty that you own the crypto. So there's a difference between, a lot of people confuse blockchain with cryptocurrencies. Just remember, blockchain is the ledger, is where all the transactions are recorded. Cryptocurrencies is just one asset class, one asset class. I just show you all the asset classes that will be tokenized. And therefore, please don't get confused between cryptocurrencies and the blockchain. Cryptocurrencies is just one of the asset classes. This is for me something that I don't know if you are aware of this, but the world in the last 2 years has totally imploded in the concept of decentralized finance. As you can see on your left-hand side, all of these little logos represent companies that have invented technology that are replacing traditional finance in every single aspect of finance, everything. So what is decentralized finance? Decentralized finance is something that it will blow you away. It's an app, it works with a smart contract, and it has the same functionality that banks produce without having to have employees, building, filing cabinets, nothing. It's just an application in the internet. So for example, if you take this little Aave, which is my favorite, which is a little ghost, what they do, you can go into the DeFi protocol and you will interact with the website, and you could actually get a loan in rands or dollars by staking. They will ask you for collateral. You can, if you have crypto that you don't want to sell, you stake it, you give it as collateral, and in return they give you fiat currencies. All of these applications are imploding, and I want you to absolutely pay attention to DeFi because the world will be converted into a complete decentralized finance in the next 10 years. So what is DeFi? That will become the norm in financial markets without a central authority. It's a place where you can do absolutely every single transaction that you normally do in legacy financial markets, but now you do it in an environment that is just a smart contract. It, of course, as you can see, you can program the payment of interest, the dividends, the redemptions. It uses the internet. It has no borders. It's universal acceptance. It interacts. Every single DeFi product is programmable and interacts with each other. So you can take one, and you're free to actually interact and create whatever you want because it's also open source. It uses artificial intelligence in order to process the financial logic. It collects data. The most amazing thing about this data, the JSC charges for the data. In the DeFi world, the data is available freely, internet, real time. It's transparent. It achieves high levels of credibility. There are applications that assesses risk and looks for liquidity and yields. The interest rates are not determined by the central bank, but algorithms. It increases the access to everybody because anybody will be able to go into a DeFi protocol and transact with them without any biases. You don't have to go to a bank and ask the bank manager for a loan and get disqualified because whatever reason. This is a very democratizing way to give access to everybody. And the most incredible thing is that if you choose to have your electronic wallet in your hand and do this all on your own without choosing an intermediary, you can. But I have to say the user experience is horrific. It's very complicated. So that's why what I would recommend and suggest that you use a service provider that can help you to do all these transactions, because it's quite scary, even for me, that I understand this area of the market. So, but this is where the world is going, and I really encourage the attendees to look into this, because this is where the financial markets are going. And this is all the time I have to cover my presentation, and therefore I will now answer any questions. I think I did well with time.
Thanks, Monica. Thank you. Great, great introduction to blockchain. I do have a question here from Adam. He's asking, and we don't have much time, if you could maybe answer this one in 1 minute. If financial intermediaries are cut out, where does that leave financial advisors in their current guise? What is going to be the impact of the blockchain on the financial advisor?
Yeah, so I truly recommend, and I said it many years ago, I gave a presentation to 500 financial advisors. I gave a presentation 4 years ago to the CFA conference. And I said, guys, if you're not learning about this, you're going to become irrelevant, because this is where the world is going. And you know why they're not learning? Because they think that they're immediately going to fear, no, this is crypto and this is used for, bad actors. Right? That fear is preventing them from learning. And the sad part is that this is changing all the time. And if they don't catch up, they truly will not add any value. And I think that's going to be the conclusion of this conference, that this is a new world and the financial advisors better get their act together. We will still need financial advisors, of course, but financial advisors that are keeping up. Financial advisors that have not bothered to study this will become irrelevant.
Another quick question. Please, could you explain how interest rates are determined and what impact would this have on monetary policy? Maybe that's, is that something that you can pick up there quickly, Monica?
Yeah, it's a complex question, because monetary policy will get affected by the fact that people are moving to privately issued stable coins, which is not part of my presentation. And therefore, the risk for central banks is that if they don't issue their own central bank digital currency, their influence in setting monetary policy would be at risk. So that's why we have such an implosion of initiatives by central banks to introduce their own digital currencies.
Thank you so much, Monica Singer. I feel that this area of blockchain development is going to be something that is truly going to be staggering over the next couple of years. We've already seen it in terms of a fractional property. You can now buy a small piece of a property in Cape Town. For example, you can buy fractional shares. You can, Monica mentioned, insurance companies are using this smart contracts to effectuate their contracts, and to you're going to see it with life policies. You're already seeing it with automobile insurance policies. So this is something that is truly going to be the revolution in financial services that Monica was speaking about. Thank you so much, Monica.
Pleasure. Thank you for having me. Bye-bye.
Going on to something which is maybe a little bit painful for a lot of people, the tax consequences of cryptocurrency investments. And yeah, the tax man is coming for your tax profits. We know that, so it's better to be forewarned. And our presenter for this section is Mansoor Parker, who is an executive at ENS Africa in the tax department. Mansoor specializes in corporate tax, energy tax, sports tax, and international tax. His clients come from a variety of sectors, from private equity to venture capital and alternative investments. And of course, the tax treatment of cryptocurrencies. This is an ever-evolving field. And he's a member of the International Bar Association and the South African Institute of Tax Practitioners and the South African Fiscal Association. Mansoor Parker, you've got maybe the most unpopular task here today, giving us the bad news about the tax treatment of crypto profits. Hopefully you can soften that blow for us to some extent. Over to you, Mansoor.
Thank you, Kieran. You've given me an unenviable task to soften the blow of the taxman who is seeking to plug the budget deficit. In my presentation, I've said it's selected tax issues simply because within the 20 minutes it's not possible to deal with the full sweep of tax issues. Apart from the income tax, capital gains tax paradigm, which is mainly what I'll be looking at this morning, there are other issues with regard to estate planning, foreign account reporting, exchange control, which all impacts on the decision-making process with regard to cryptocurrency. So what you'll see this morning is a very small snippet of one of a range of issues on cryptocurrency, but it's not the full sweep of issues. What I thought I'd do is start off with the why is it not okay, is started with a few slides just looking at some basic tax design issues. The latter half of my slide deck will look at more specific issues impacting on crypto miners, investors, traders, but I thought I'd like to locate it within the tax design paradigm. And the issue that one will be confronted with is when you're dealing with cryptocurrency, does it sit on the income tax side of the paradigm or on the capital gains tax side? Now the two are interlinked, but the process to determine the taxable capital gain or your income tax is different. In essence, there's two things that we're seeking to establish here. Number one, what is the amount of your taxable income? Number two, how much taxes do you pay? And there are two processes to arrive at those answers. In the income tax column, there's a fairly simple process that there's income minus certain things that gets taken out of the pot in the form of deductions and exemptions. You'll end up with a taxable income. I've just assumed that you're dealing with taxpayers in the 45% tax bracket. And if your taxable income is in that bracket, whatever taxable income is will then be taxed at that 45% rate, and you'll end up with income taxes that's payable. On the capital gains tax side, conceptually, it moves in a similar manner. You dispose of an asset and you get your proceeds. Then you deduct the costs that you paid for that asset. You have an annual exclusion, and then a certain portion of those proceeds of the capital gain is transferred to your income tax calculation. 40% of that gain. And because 40% of the gain is transferred, the calculation that's made is 40% of 45% equals 18%. And that's why we normally refer to a capital gains tax rate of 18%, even though in reality there's no capital gains tax rate, strictly speaking, but that is the effective rate that you will pay on a capital gain as opposed to an income gain. So it then becomes important to determine where the sale of cryptocurrency, whether it's Bitcoin or Ethereum, will sit in this paradigm. Now, traditional tax principles had it that where you acquired an asset and you had it for the purpose of resale at a profit, that would be sitting on the income tax side, the 45% side. However, where you acquired the asset and was not held for the purpose of resale and you intended holding it for a relatively long period of time, and importantly, the section in red, where that asset produces a revenue stream in the form of rent, interest, or dividends, then that would sit on the capital gains tax side. And the commissioner for SARS and SARS themselves, they made some statements where they've said that they feel that cryptocurrency is a speculative asset and that it's more likely to sit on the income tax side than the capital gains tax side. And I think the reason for that view might have been that unlike property or shares, it doesn't produce any rental income or dividend income, but that view, given the introduction that Kieran has made, is not entirely correct because it is possible to achieve that return. So I think there's going to be some very interesting debates with the tax man on whether the gains from cryptocurrency will sit on the income tax side, which is the far higher tax rate, the 45% rate, or the capital gains tax side, which is the far lower rate, the 18% rate. Now, selected legislation, cryptocurrency has been included in the definition of a financial instrument. That's interesting for so-called wash sell transactions. Now, wash sell transactions are transactions where you anticipate a dip in the price of an asset, and you sell that asset in order to lock in the capital loss from that dip. And if you're confident enough in your prediction of the market, you'll anticipate an upward curve spike in the price of that asset. So you buy it at the lower price, and then you hold it as it gains in price. But now you've locked in a capital loss, which you can then set off against other capital gains. There are certain wash sale rules which limit your ability to make use of this technique, and they refer to a 45-day period. Now, because cryptocurrency has been included in the definition of financial instrument, cryptocurrency falls within those wash sale restrictions. So when we're looking at the more technical type of holders of assets who are looking at sales in and out, it's important to bear in mind some of the tax rules which might limit your ability to make use of this to the fullest extent. From a VAT point of view, cryptocurrency is regarded as an exempt financial service. The VAT-minded people in the audience will pick up immediately that creates an apportionment issue for companies which has taxable income and exempt income from a VAT point of view, which should need to be resolved quite carefully. From a SARS point of view, moving away from legislation, just public statements made by SARS. SARS issued a media statement in 2018, not a very detailed statement, in which they stated that cryptocurrency is an asset of an intangible nature. Many people felt that this statement indicated an intention by SARS to start taxing cryptocurrency, but the SARS view was that it was a clarification that they will always taxing cryptocurrency. It didn't start from April 2018. It's something that they want to clarify to people involved in transactions that this is the SARS stance with regard to cryptocurrency. And I will deal with the issue of that asset in a later slide. There's been further statements by SARS Commissioner earlier this year that is going to be a big area of SARS audit activity. There's been reports in the paper that those who have bought cryptocurrencies are being audited by SARS with letters requesting more information about these investments, as well as media reports about platforms such as Luno receiving requests for downloads from their customers, presumably for tax purposes, and a statement in the SARS Comprehensive Guide to Capital Gains Tax where they said that given the extreme volatility, SARS will regard cryptocurrencies as a speculative asset of a revenue nature. So they're giving their indication, they're giving their signal that they think that sales of cryptocurrency falls on the revenue side rather than the capital gains tax side of the equation. From a tax administration point of view, it's an area that's constantly evolving. There's been certain source codes inserted into tax returns for CGT purposes. Foreign bank accounts, there's increasing exchange of information between different tax authorities. So having a foreign bank account doesn't necessarily insulate you from a query from SARS. The onus is on taxpayers to declare cryptocurrency-related taxable income in the year in which is received or accrued, not from 2018 onwards, but for all years prior to that. And to the extent that has been a failure to do so in previous years, SARS does have a voluntary disclosure program process, which allows taxpayers to deal with historical underreporting of cryptocurrency transactions. So when we get onto the more cryptocurrency-specific statements issued by SARS, on April 2018, SARS stated in the media statement, crypto asset is taxed as an asset of an intangible nature, not currency. That's not official South African tender. Because crypto assets is an asset, the currency gain and loss rules do not apply. Instead, the general rules do apply for sales and exchanges of crypto assets, where we have to place it within the income tax or the capital gains tax paradigm. Now, how does this affect entities involved in this space? I'll be looking at three different types of entities, three different types of persons: miners, investors, and traders. For the purpose of this discussion, I just assumed that the persons that we are looking at are individuals rather than companies operating in the space. In the 2018 media statement, SARS gave their description of mining, and they said that the miner is rewarded with ownership of new coins, and this gives rise to an immediate accrual or receipt on successful mining of the cryptocurrency. So according to the SARS media statement, when somebody is involved in mining transactions, and they would have undertaken a lot of effort to get to that point, apart from buying the mining rig, they might have set up some solar panels for energy and UPS systems and air conditioning to keep the room cool and laptops. There's quite a bit of expense that goes into that process. That when they are rewarded with the ownership of the new coins, that is an immediate accrual or receipt at that point in time. And further on in their statement, they felt that this would be held as trading stock by that particular miner. So it does then create a question on their statement that at which point tax would have to be paid. Would it be at the point where the miner receives the ownership of the new coins, which would be the accrual of the receipt, or later when it's sold or exchanged for cash? So I think what there definitely is a need for SARS to issue more guidance around the tax rules as it would apply to miners, because based on their statement, what they appear to be saying is that where you're mining Bitcoin and you receive the Bitcoin as a result of your mining activities, at that point, you must record an accrual or receipt for tax purposes and then work out whether you're paying income tax or capital gains tax on that accrual at that point in time. So that could be a very big issue for those involved in the mining space. For investors would typically not hold cryptocurrency as a trading stock. They're typically not conducting a trade or a business in the traditional sense and don't have any marketing or promotional material. There's no signpost outside. There's no customers or anything. They're simply buying and selling for their own benefit. Here, the basic rules concerning capital gains and losses should apply. That it's an asset which is held for a relatively long term. There are rules in the Income Tax Act which says that where you hold certain types of assets for more than 3 years, such as shares, those shares automatically qualify for capital gains tax treatment. However, cryptocurrency is not included in that basket of assets that qualifies for that for capital gains tax treatment. So one would then have to look at the traditional rules in order to determine whether the gain that one has is of an income nature or of a capital nature. Now, I'd like to repeat this, the statement made by SARS, that where they said cryptocurrencies are likely to be held as a speculative asset of a revenue nature. And this statement is naturally, it's not a binding ruling on the part of SARS, because it's written in their guide, which is a non-binding document. But what it does do is it gives their view. And in order to overcome this, it will be very important that anyone who is active in the space just keeps proper records of dates of purchases, dates of sales, to show that there's an insufficient frequency of transaction to push one from the investor classification to the trader classification, and that it doesn't have the hallmarks of a business, and that this is more on the investment side and should therefore qualify for the more preferential and lower capital gains tax rates rather than the higher income tax rates. Because one is in the investor box, there's certain deductions that you wouldn't be able to claim because you'd say you're not running an active trade or business, such as home office deductions, but those sorts of deductions may possibly be claimed on other types of income that you have, but it wouldn't qualify under this particular header. Traders would typically not have any customers to them. They're not typically your intermediate type of persons, but they would be treated as carrying on a scheme of profit making for tax purposes. There's normally a frequency of trading activity, and therefore SARS would be quite keen to put traders into the income box, not the capital gains tax box with the 18% rate, but the income tax box with the 45% rate. It does mean that traders would be able to deduct losses against the taxable income, but there are certain restrictions that you might get traders who are more business orientated, and you might get traders for whom it's slightly more of a hobby. There are rules in the Income Tax Act which limit losses arising from trading in cryptocurrency, and where those losses are ring-fenced, then it means that whatever losses you've incurred in trading cryptocurrency can only be set off against gains which you make from trading cryptocurrency. So it's ring-fenced in that way. You can't set off the losses against other types of income that you have. So it will be very important for those in the trading space to ensure that the ring-fencing rules does not apply. Now, in this table, I sought to put in an example between someone who is classified as a trader and someone who is classified as an investor. In the example, both they bought the cryptocurrency for 10,000. It showed tremendous growth. It's now valued at 100,000, and they decided to take some gains off the table. In the investor box, the gain is 90,000, and because you're dealing with an individual, they qualify for the annual CGT exclusion of 40,000 Rand, which reduces that gain to 50,000. 40% is the inclusion rate. That is the portion of the gain which will be taxed and the income tax purposes. So 40% of the 50,000 means that your taxable capital gain is 20,000 Rand. 45% of that amount leaves you with taxes payable of 9,000. So 9,000 from a sale of 100,000 gives you a fairly generous effective tax rate. If however you classified as a trader and you bought the crypto for 10,000, sold it for 100,000, your income gain is 90,000. Your tax rate on that is the full 45%, which equals taxes payable of 40,500. So the difference between the two is an indication of why SARS is so keen to ensure that if you are in the trader box, that you don't misclassify yourself as an investor. And hence their questions would be around determining whether you should actually be in the box of the trader rather than the investor box. In the next one, I considered the example of an investor who decides that instead of selling the Bitcoin for cash, the investor decides that of the cryptocurrencies that he or she has, thinks Ethereum is doing quite well, wants to swap out of Bitcoin and go into Ethereum. Either there's a direct swap of the Bitcoin for the Ethereum, or the Bitcoin is sold and the cash proceeds are used to buy Ethereum. But in the mind of the investor, there's an exchange of the one for the other, and no money is taken out of that particular trading platform. The money is left in. So no cash goes from the platform into the investor's bank account. It's simply used to exchange the Bitcoin for the Ethereum. Now, that is also a taxable event, even though you're not withdrawing any cash from that platform. And conceptually, the same process applies. Where the Bitcoin is exchanged for the Ethereum, there'll be a value for the asset that's been acquired. So where you receive Ethereum to the value of 100,000, those are your proceeds that you would have received. It's not in cash; it's in the form of an asset, but that's the amount. Then from there, you deduct the amount which you paid to acquire the Bitcoin. In the previous example, we said that we would assume that you paid 10,000 to acquire it and you sold it for 100,000. So from this point, the calculation works the exact same as the one in the previous page, even though you're not looking at an actual sale, but you're looking at an exchange, but the tax consequences works out the same. In this table, I put in the arrows to indicate how the 9,000 is related to the 50,000. The 9,000 is effectively 18% of the 50,000, which is how we get to the effective CGT rate of 18% that we normally quote. But the exchange, there's meant to be a parity between the sale for cash and the exchange for another asset in the tax treatment. There's no automatic rollover provision. So we can't go to SARS and say, well, I've replaced one cryptocurrency for another one. Why should I be paying tax? I've still got crypto. It's just instead of the one, it's the other. There are certain rollover provisions in our capital gains tax provisions that deals with situations where you can roll over one asset for another without paying tax on it. But this is not one of those situations that qualifies for that treatment. I have about one slide to go, Kieran. So let's assume that the investor decides, well, instead of doing the sale, instead of doing the exchange, how about I simply donate a portion of the Bitcoin? I'd like to give it to a tax-exempt foundation. And I'm going to make the donation to the Bitcoin, and I'll claim a deduction on the amount of that donation, and I should be in a fairly good position. There's a bit of a sting in the tail in that route as well, that the rule is that the investor may deduct the lower of the fair market value of the cryptocurrency or the cost to the taxpayer of such asset, whichever is the lower. So because the investor paid 10,000 Rand for the cryptocurrency, that would be the amount that's available that's eligible for the reduction. The tax benefit therefore be 45%, 4,500. In those circumstances, it would actually be easier for the investor to simply sell the cryptocurrency, provided it's tax at capital gains tax rates, pay the 9,000 Rand CGT, take the 91,000 cash as left over and donate the 91,000 Rand and get the reduction on the 91,000 Rand instead. So that was a pretty quick overview of some of the issues involved in cryptocurrency trading. It's something that if you're doing it with regularity and the amounts are big, it would be well worth your while to speak to somebody involved in tax to ensure that you got the correct tax treatment and the correct tax compliance and reporting as well. Thank you very much.
Thanks so much, Mansoor. Wow, I learned a few things there that I didn't know. A couple of questions quickly, if you can just cycle through these like in a minute or two.
Sure.
Somebody's asking here, if crypto is online and borderless, what is the philosophical basis for taxing the investment within a bordered geographical region? I guess this kind of does get to the heart of the whole crypto debate. You know, are we going mainstream and traditional once we start taxing within borders?
Yeah. It's an interesting question because there's certain countries in the world that taxes on a worldwide basis, and South Africa is one of those countries. So where you tax resident in South Africa, then whatever income you earn, capital gains you earn on a worldwide basis will be taxable in South Africa. So the concept of the geographical border limitation is not recognized where we're a resident of South Africa. Where it's someone who's non-resident in South Africa, then the geographical limitation applies. So if a foreigner does certain activities in South Africa from which they derive income, then those activities within our geographical borders would be taxed. The philosophical rationale on whether one should limit taxing rights to the geographical borders of one country or extend it on a worldwide basis, I think that would be possibly a useful debate to have. But from where we currently are, the South African tax rules applies on a worldwide basis.
Okay, and very quickly again, if I, as the MC for this event, get paid partly in cash and partly in crypto assets, do I declare both amounts for tax purposes, or do I only pay tax on the crypto assets when I sell them for cash?
Again, it's interesting question, because normally from a capital gains point of view, it's a realization basis that you only pay tax when you realize an asset, when you sell it, not for the period that you're holding it. But if you were to be remunerated in the form of cryptocurrency for services which you render, then it becomes a form of compensation which is immediately taxable. And if your remuneration consists of a non-cash element, such as cryptocurrency, then it would have to be valued. And then that value would have to be inserted in your tax return. So if you retain the cryptocurrency, you've got the tax event that you but there's also a cash amount payable for tax purposes. So effectively means that you'd have to sell some of the cryptocurrency in order to pay the taxes due on that amount. So there is a slight mismatch when you get paid in an asset, because you don't receive the cash to pay the tax liability, but the tax is still due, except the tax is due on the value of the asset which you receive.
Right, and again, very quickly, Mansoor, if you can answer this one, that's quite a good question. What are the tax views on DeFi loans? In other words, if you got Bitcoin and you go to Uniswap or Aave or someplace like that, and you use that as collateral for a loan, does that fall into the normal tax provisions for lending?
That would have to consider. If it's possible, we could raise that in the breakaway room in about 20-30 minutes time, and I could have a look at that.
Yes, great idea. Okay, Mansoor, we're going to leave it there. I think for the person asking this question, Mr. Anonymous, please hunt down Mansoor in the breakaway rooms at 10:30, and you can ask him that question personally. Thank you so much, Mansoor. That was fantastic. Well done.
Thank you. Thank you very much.
Okay, now we're going to look at regulation. Now, apart from death and taxes, the other certainty in life is that regulation is coming to the crypto space. Most companies operating in this space welcome this development, if for no other reason that it will provide comfort to members of the public who've grown jaded by the number of truly terrifying scams that have emerged out of South Africa. Our presenter for this subject is Professor Angela Itsekowitz, a director at ENS Africa, Africa's largest law firm. Professor Itsekowitz is a banking and finance expert and co-heads the newly established fintech department at ENS Africa. Angela, I think this is something that people are, concerned about. There's some trepidation about the regulations and exactly what does that mean. And I think the people who are most concerned are A, the holders of crypto assets, and B, the exchanges. And maybe you can take us through what does this mean? How's it going to affect our lives?
Sure. Thank you very much, Kieran, and thank you to everyone for having me. So let me start by debunking the myth that cryptos are not currently regulated. I think Mansoor has done this certainly in respect of tax. So while it's true that there's no overarching or bespoke cryptocurrency or fintech regulation, it's simply not true to say that cryptos are not yet regulated. Why do I say that? Because the South African regulators adopt what we call a functional approach to regulation. They look at the function of the instrument, the function that the cryptos fulfill. They adopt a technologically neutral approach, an institutionally neutral approach to regulation. So I don't have a presentation, but just to give attendees some indication of the structure that I propose to consider today. What I'm going to do is I'm going to look at existing legislation, which might regulate, or does regulate rather, cryptocurrencies as we stand today. Then I'm going to move to the proposed changes that will be made to bring cryptos clearly within the regulatory net. And then I'm going to say, well, having heard the proposed amendments, what is the takeaway for crypto asset services providers across the board? But before moving to that structure, I just want to make the point that the IFWG, which is the FinTech Working Group, and the Crypto Asset Working Group, that in their position paper, they've called for a staged approach to the regulation of fintech. And interestingly, they've defined 3 key areas. The first being anti-money laundering and terrorist financing legislation. The second being cross-border financial flows, the dreaded ex-con. I think that's almost worse, Mansoor, than the tax, at least for the players in the space. And thirdly, financial sector laws. So against that background, let me turn to the structure. Let me start with anti-money laundering. Now, anti-money laundering is regulated in terms of a number of statutes in South Africa, but I'm going to focus mainly on the Financial Intelligence Center Act, FICA, which everyone is by now familiar with. So FICA in the main, and if I had had a slide, I would certainly have bolded or underlined the words in the main. So FICA in the main applies to accountable institutions. Accountable institutions are defined in the schedule to the Act, and currently crypto assets are not, or crypto asset service providers are not defined as accountable institutions. What are the obligations imposed on accountable institutions? A myriad. You have to do proper KYC, you have to keep record, you have to report cash above a certain threshold, one has to draft a detailed compliance risk and management program, one has to do ongoing due diligence of clients, and also has to accountable institutions have to identify beneficial owners. So that's accountable institutions, which are regulated by FICA, and some of the obligations imposed on these accountable institutions. CASPs, or crypto asset service providers, not yet accountable institutions. So how does it apply to you? If I said that there are some laws that already apply, well, they apply in the following way. In addition to applying to accountable institutions, there's a section 29 for those who are interested, which obliges not only accountable institutions, but every person who carries on business or who manages a business or who is employed by a business to report suspicious and unusual transactions to the Financial Intelligence Center. So all of the attendees who are engaged in business of any kind, never mind the crypto business, all of you currently have to report suspicious and unusual transactions. That's the current situation. Proposed changes? Well, South Africa is a member of the Financial Action Task Force, and we domesticate our legislation along the lines of the principles of the Financial Action Task Force. Now, what's coming is all crypto asset service providers are going to have to register as accountable institutions. Takeaway. Many of you will say, well, we're not awfully worried about FICA. We are already registered as accountable institutions. We already do extensive due diligence requirements on our clients. We already monitor our clients, and that's well and good. But although the FICA legislation adopts a risk-based approach, there are a number of very heavily regulated prescriptive requirements which CASPs will now have to comply with. It's not good enough to say we are already registered, look at the due diligence, look at the compliance that we do. You will now have to comply to the letter with the FICA legislation. So what I strongly suggest you do, your takeaway here is you need to make sure that you comply with the Financial Intelligence Center, the Center Act, in preparation for when the Act is amended. You certainly need to start drafting or giving some thought to your compliance regulation management program, and having someone check your internal legal advisors, external legal advisors, that you are compliant with FICA. I think many of you will have seen that the FIC is all over the place, and it is continuing to apply very, very severe administrative penalties on non-compliant accountable institutions. In addition, there are a number of criminal sanctions which may be applied for non-compliance. So that's AML. Moving now to financial market legislation. Currently, FASE, the acronym for the Financial Advisory and Intermediary Services Act, currently that act regulates financial services in respect of financial products. What are financial products? Defined fairly extensively to include the likes of participatory interests, securities, insurance premiums, benefits under Friendly Societies Act, medical aid contributions, and the like. Then there's a catch-all which says, and includes any other instrument which is similar in nature to any of those on the defined list. So currently, crypto assets are not financial products. Let me just finish the reach of FASE. If something is a financial product, then a twofold inquiry follows. Is the entity giving advice in respect of that financial product? And/or is it rendering an intermediary service in respect of that product? If the answer to either of those second points is yes, that entity will have to register as a financial services provider in terms of phase. Their existing position, crypto assets not yet financial products. So it doesn't matter if you give advice, it doesn't matter if you act as an intermediary. As we speak, you are unregulated. And that has been a huge frustration for the Financial Sector Conduct Authority in trying to bring these crypto asset swindlers to book. These swindlers, through their lawyers, simply take the point that the Financial Sector Conduct Authority has no jurisdiction. And I myself have taken that point, and that is the correct view as we speak. Going forward, what are the changes to the legislation? The changes, in a nutshell, without going into the technology as to how those changes came about, the Financial Sector Conduct Authority has, in a declaration paper, said that crypto assets are going to be included as financial products. They've taken a shortcut there on the basis that they've said crypto assets are similar in nature to the products listed, thereby obviating the need to have to go for an extensive amendment of the regulation. Whether this is correct in law or not, and I don't think it is, because I don't think cryptos are similar, at least not all cryptos are similar to the existing defined products. We know, for example, that there's no central issue. However, if one has regard to the products currently defined, all of them do have a central issue. Be that as it may, crypto assets are going forward going to be included as financial products. If any of you therefore give advice or render intermediary services in respect of these products, you will have to register as a financial services provider. Now, it's not that simple. First of all, a lot of people are coming up with very interesting and arcane products, attaching a crypto to a derivative, tweaking one or more financial instruments to the crypto. How then do you define your product offering? Is it a crypto or does it have elements of both? Now, it's going to be quite difficult because those who are currently registered as financial services providers are going to have to go away and look at their license. Clearly, their license doesn't cover or provide for financial services in respect of cryptos. Their existing license is not going to avail them any because it's product specific. So those who are already registered are going to have to review their licenses and apply to have their products extended. Now, herein lies the difficulty. In meeting the fit and proper requirements, one of the fit and proper requirements is experience and qualification. Now, yes, there are a number of courses out there which deal with cryptos, which deal with regulations, so very good courses, might I add. But will those kind of qualifications meet the SACWA qualifications that the FSCA requires? Also going to bring about added expenses, of course, and we all know that those expenses are covered ultimately by the consumers. So what's the takeaway? The takeaway is, guys, whether you are currently registered as financial services providers or not, in that the only space you play is cryptos, you've got to think about how you register first as a financial services provider. Secondly, and much more difficult, is for you to familiarize yourself with all the obligations, a myriad of obligations imposed on you in terms of the Financial Advisory Intermediary Services Act. What can you do? What can't you do? You're going to have to consider very carefully conflict of interests, treating customers fairly. Your takeaway here really is that you have a lot of homework to do in preparation of your having to be registered. The minute you're a registered financial services provider, you also afford to be regulated by FICA. So 2 sets of regulations you're going to have to give a lot of thought to. FAIS doesn't yet regulate business conduct in respect of crypto asset providers, but in the medium term that is coming, you're going to be governed by the Financial Sector Regulations Act. You're also going to be governed by COFI, which deals, among other things, with treating customers fairly. So that's the second set. Before I leave crypto, the FAIS, I just want to make one point, going back to my original thesis, and that is that you may currently be you may currently be regulated already. Now, given that FAIS adopts a function, FAIS, like all other regulation, adopts a functional approach to regulation. If you are playing in the ICO space and your token is a security token, FAIS may well require you to register as a financial services provider in respect of that security token. Moving then to the third topic, and probably the most controversial, certainly for the moment, is the exchange control. Now, South African exchange control regulation has a negative framework. Pretty much, despite the relaxations over time, the thrust of the Exchange Control Act, the Currency and Exchanges Act, and certainly the regulation is that you can't do anything without permission. The Crypto Asset Working Group has recommended that the Financial Surveillance Department, FinServ, should have regulatory oversight of crypto assets and crypto asset services providers. And as I said, the current framework is that you can't do anything without permission. Now, this is the very interesting point. Every single question that we've had to deal with turns, in essence, on whether cryptos constitute capital in terms of Regulation 10(1)(c) of the Currency and Exchanges Regulation. Do crypto constitute capital? Does crypto touch on the right to capital? Now, I wish I could give you an easy answer, but I can't. So there's certainly people in the market who take the view that cryptos do not constitute capital, and there's certainly support for this argument. One example is that the Crypto Asset Working Group in the policy paper itself provides that in order to bring cryptos within the framework of exchange control regulation, Regulation 10(1)(c) would need to be amended to bring cryptos specifically within the regulatory net. Now, if cryptos are already capital, why the need for the statement that the regulation needs to be amended? Maybe from an abundance of caution, or maybe there's something more. What's really worrying and what's really set the cat amongst the pigeons is the statement in the FAQs. The question put in the FAQ was, may I buy crypto assets on a local exchange or South African trading platform with Rand, and then send those cryptos to an offshore exchange? And the answer was a resounding no. Worse, they said Regulation 10(1)(c) prohibits transactions where capital, the right to capital, is directly or indirectly exported. And if you do this, you will be contravening Regulation 10(1)(c), and such contravention may be visited with criminal liability. Takeaway, I really suggest that you give some very careful thought as to whether what you are doing falls within the current existing regulatory framework, namely Regulation 10(1)(c), and possibly take some expert advice on this. A problem, and I hate to leave on a down note, is that even if we were to challenge the SARB on cryptos not being capital, they could do, as they have done before, simply amend the regulations to bring it expressly within its reach. But I could literally speak for a week on this. You can't regulate through FAQs. What about all the other measures that the FinServ department has said is going to be putting in place? Fixing the BOP reporting, looking at the Adler requirements. But let me leave you then on that note. Hopefully you've understood existing regulation, proposed amendments, and the takeaway for yourselves.
Thank you so much, Angela. Just a quick question to wrap up here. There's a question that came in. What about loan agreements? Will people be able to lend and borrow crypto assets? And is there any regulation that have to comply with? So you've already spoken about the FISE Act and FICA, and these are two pre-existing laws which do cover the crypto space. And of course, the Taxman, in terms of the Tax Act, has also embraced crypto. So what about this? What about loan agreements? Is there any regulatory coverage for that?
Thank you, Kieran. Thank you to the questioner. That's an absolutely excellent point and a very interesting one. So what one certainly can't do is to go around and to purchase somebody's single discretionary allowance, okay, or either the million or the 11 million to purchase it, so that the purchaser can use it to get capital offshore and effectively give a loan to the person. That one can't do. It's the SARB has said you can only use your own SDAs. But a different point, and I think closer to the question that you've asked, Kieran, what about if I say to you, I'll lend you 10 Bitcoins. You must repay me with or without interest, either in fiat or in crypto. Now, we've actually had a look at this question, and it's a very interesting one. And my take on this, and of course, there's a lot of jurisprudence and a lot of legal thinking that went around this, is that there's certainly an argument that the National Credit Act, as is currently drafted, refers to the loan of money. And that's all. And we know that cryptos are not money, it's not e-money, and it's certainly not currency. So I think one would have to bolster an argument around that cryptos are not money, and therefore one could escape, at least on the lending side, the regulatory net of the regulatory National Credit Act net.
Fantastic. Thank you so much, Angela, for that. And we do look with some trepidation to what's coming down the pipeline in terms of regulation, supposedly during the course of this year. Okay, we're going to have to move on here, and I just want to remind people that there are breakaway sessions that are happening in a few minutes. If you look on the left side of your screen, there's sessions. You can go, if you want to speak to Monica Singer or meet up with her, go to room number 1. Mansoor, you can meet in room number 2 for any of your tax questions. Angela, who's going to discuss regulatory issues, you can meet up with her in room 3. And our next guest, who is going to be available in room 4. But before we do that, we want to get into the subject of cryptocurrency arbitrage, which for many people is their first point of entry into the crypto space. It's become quite a business in South Africa. Angela just touched on it there. You cannot be a mule for cryptocurrency arbitrage. In other words, give your allocation, your SDA, your special discretionary allowance, or your foreign investment allowance to somebody else. I want to welcome Andoni Nicolaou, who is a BSc in Actuarial Science and Stats from Wits University. He has pursued entrepreneurial ventures until Bitcoin reignited his interest in finance. And he's since dedicated himself to understanding money and markets. And he leads Geltech's digital investment offering. Welcome, Andoni. And maybe just as a kickoff, explain for people who don't know what cryptocurrency arbitrage is. Andoni, are we? We're not getting you. Are you hearing us? Okay. Let's try and sort that out. Well, maybe I'll just talk a little bit there about cryptocurrency arbitrage. I think that Andoni was going to talk about the offering that Geltec has just recently introduced. Cryptocurrency arbitrage, for those who are not familiar with it, that is basically the exploiting the price differences between local and overseas exchanges in crypto assets like Bitcoin. But it's extended beyond Bitcoin to Ethereum and to stable coins as well, like USDC, and it's become a huge business internationally. It's usually exists in countries which have exchange controls like South Africa. So you got to get this mispricing between South African and overseas exchanges. The cryptocurrency gap has narrowed considerably over the last 3 years. If you go back to 2017, people will tell you that at that time you could exploit a gap of 5 to 8% quite frequently, and at times went as high as 20-25%. So that gap has come down, and it's because people have woken up to this, that it's an opportunity here. The more people that do it, of course, that profit opportunity declines, but it never completely disappears. It's always there. And it gets reignited at some point when an event happens that sparks interest. That usually you'll find when Bitcoin price, for example, is moving, the crypto arbitrage gap returns. So the crypto arbitrage, I don't think it'll disappear. It'll become narrow. It'll become more difficult to exploit it, but I think it will remain with us as long as we have exchange controls. Do we have anything, Keegan, there for Andoni, or should we just break away now?
Not yet. We are still seeing if he is going to come up yet. But
is there a problem with the Wi-Fi there? I think then what we should do is just break away.
I can see Andoni now.
He's going to let me in.
There you go.
Okay, Andoni, can you hear us, and can we hear you? Just speak, please.
Yeah, I can hear you loud and clear.
Okay, good. All right. Andoni, I've given you an introduction. Maybe just...
Thanks very much. I'm just going to share my slides now.
Yep.
Okay. All right, you guys should be able to see my slides.
You're good to go.
Okay, great. Thanks very much. All right, well, thanks for that introduction, Kieran, and apologies for the technical difficulties. My name is Andoni Nicolaou, and I am going to be taking you Geltec's cryptocurrency arbitrage. I am the head of digital asset operations at Geltec, and I'm quite excited to share this opportunity with you because we believe we have created the safest arbitrage in the market. So what I'm going to do is I'm going to take you through some of the basics of the investment, how it works. You may already be familiar with that. I'm going to go into some of the risks that we face during this trade and take you through exactly how we mitigate those risks. Before jumping into that detail, let me give you some background into Geltec, who we are and what we do. We consider ourselves alternative investment specialists. Between our fund administration and fund management businesses, we manage over 3.6 billion rands, and that represents over 1,000 investors. And our cryptocurrency division has been responsible for over 700 million rands worth of trades. Right, now getting on to the crux of the matter, arbitrage. I always like to start off with the definition, just to ensure that everyone's on the same page and we know what we're talking about. So what is arbitrage? Arbitrage is the practice of taking advantage of price differentials between two or more markets. At times during my presentation, I might spread is exactly as a price differential. Right now, so mismatch we found in the cryptocurrency market, specifically in the price of Bitcoin offshore and Bitcoin in South Africa. So the best way to visualize how an arbitrage works is to think of a loop. When we find these mismatches, we need to create a closed loop, and that loop is what allows us to exploit the spread, and that's ultimately how we make a profit. So if you think about starting off with 100,000 Rand in South Africa, that 100,000 Rand needs to be sent offshore. Once it lands in the UK, you can buy the relatively cheaper Bitcoin. The Bitcoin then needs back to the local market, where it can then be sold at the relatively higher price, and we should be able to realize a profit of 1,000 Rand. Just take note, the numbers I'm using are just for illustrative purposes. So in this example, a spread of 1% would result in a profit of 1,000 Rand at the trade. Now, once you find these mismatches, the real opportunity lies in being able to repeat the loop over and over again. Because every time you complete a loop, that's when you actually realize a profit. So for us, this offers a great opportunity, but we're also limited, and Angela briefly mentioned about exchange controls. So we are limited by exchange controls. But there's an opportunity, first and foremost, with the R1 million single discretionary allowance. This allowance applies to all South Africans. It's freely available. You don't need any special permission to access it. So once a client has given us the authority to use their SDA, it means that we can then repeat that same. Instead of just looping it once, we can loop it 10 times. And by the end of that process, we'll end up with 10,000 Rands profit. So we've, instead of just 1,000 Rand once off, we've now multiplied that by 10. Okay, going another step further, we're also entitled to a foreign investment allowance, or an FIA. Now, this is a little bit trickier because this does require a clearance from SARS before any additional funds can be sent offshore. And this allowance can go up to a total of 10 million Rand that investors can allocate offshore. And once again, that's where the real opportunity lies, because extra allocation towards this investment means we can do more loops, and with more loops, we can earn more profit. And we can do all of this without requiring any additional capital outlay. So once again, if we start off with that 100,000 Rand in South Africa, we loop it around, and on top of the 10 times that we can do with the SDA, if we have permission to utilize an investor's FIA, we can then do that an additional 100 times. And that significantly improves profit, with the potential of earning up to 100,000 Rand just in profit. So in summary, what is the opportunity? The total opportunity is an individual's 11 million Rand foreign allowance, which consists of a 1 million Rand SDA and a 10 million Rand FIA. And that 11 million Rand is fully accessible with a nominal deposit, with as little as 100,000 Rand. Investors can deposit more than that if they like, and it does make it more efficient and slightly more profitable. But for most individuals, 100,000 Rand is a much easier amount to start off with. So I did mention that we believe we have the safest trade, and our track record speaks towards that. We've traded more than 700 million Rands to date. We trade every single day. At the moment, we're averaging between 7 and 10 million Rand. And the fact that we trade every single day ensures that the turnaround time for this trade is as quick as possible. Investors don't need to forego their deposit for an enormous long amount of time. Generally, we're seeing turnarounds depending on how much of their allowance is allocated towards this investment. And SDA can take us less than 10 business days to turn around back to clients. We've traded over 3,000 times, and in all of those trades, we've never recorded a single loss. And I'll speak towards how we do this in the coming slides. Okay, now I keep mentioning and harping on about how safe this trade is. Safe, of course, does not mean that it is risk-free. So every time we initiate a loop, we're exposed to a number of risks. We're exposed to market risk. That's in both foreign exchange markets and the crypto markets. We're also exposed to a little bit of counterparty risk and regulatory risk as we touch capital controls. Now, cryptocurrencies are notoriously volatile. So it was absolutely imperative for us to be able to mitigate our exposure to market risk. Now, I can show you exactly how we do that. So on step 1 of our trade, we have to send rands offshore, in this example to the UK. As soon as we do that, we're exposed to fluctuations in the foreign exchange rate. Now, the way that we have set up our loop, we are 100% hedged, and we are never exposed to any fluctuations in the foreign exchange rate. So even if the rand strengthens during the time that we are initiating a loop, it will not affect our spread, and it will not affect our ability to make a profit at the end of the loop. Once we've actually sent the money offshore and acquired the Bitcoin, our exposure moves away from the foreign exchange markets, and we now run the risk of being exposed to the crypto price of Bitcoin. Now, if Bitcoin devalues in the time between us purchasing the cheap Bitcoin in the UK market and selling it in the South African market, again, we risk losing our spread, and we risk actually trading at a loss. So how have we mitigated this? We've partnered with a company called GSR. They are one of the largest and most experienced crypto traders in the market. And through their systematic trading engine, they are able to execute both legs of the Bitcoin trades in fractions of a second. And that essentially completely eliminates our exposure to fluctuations in the Bitcoin market. It also means that whether the price of Bitcoin is going up or trending downwards, again, it makes no difference, because we are simply taking advantage of the spread and the price differential between the UK price of Bitcoin and the South African price of Bitcoin. So I've dealt with how we handle market risk and how we mitigate that. We also run a small element of exchange risk or counterparty risk. Thankfully, it's not the early days of crypto anymore, when it was pretty much the Wild West and exchanges were being hacked left, right, and center. Today, they have matured a great deal. Security is way more advanced. And incidences of hacking are very, very rare these days. Even with this in mind, we only trade on the most reputable and longest running exchanges, and we're only ever exposed during the execution of that loop, which, as I hope I showed, is actually a very short space of time. We don't leave assets sitting on there for days on end. As soon as funds become available, we withdraw them and they go back into client accounts. Touching back on the regulatory risks, capital controls have been discussed, and we are fully compliant at every step of the trade. All of the volume that we trade goes through authorized dealer, and that ensures that we are compliant and that we monitor every single client's limits to ensure that they never exceed their allowance. So how does someone take advantage of this? It's really simple. All we need from clients is an initial deposit and for them to fill out a couple of simple forms. And from that moment forward, Geltec handles the rest. We do all the admin. We obviously monitor the trades, and we report to you on a monthly basis to show exactly what kind of profits you have earned. So while most South Africans, or average South Africans, would typically go year on year and just forgo their foreign allowance, Geltec's arbitrage offers an opportunity to make a nice little profit at a very, very low risk. So for anybody who is interested in this opportunity, please feel free to reach out to me. I'll be available for questions, and my email address, as you can see, is on the slide over there. So thank you very much.
Thanks so much, Andoni. Okay, we're going to break away now. If you want to chat to Andoni about that, please go to the breakaway room there. He's going to be in room number 4. And as I said before, if you want to chat to Monica Singer about blockchain, you can meet her in room number 1. And these buttons, by the way, if you look on the left side of your screen under sessions, you'll find the different breakaway rooms there. Mansoor for tax, any tax questions in room number 2. Angela Itsikovitz is going to be talking about regulations. You can meet her in room number 3. And as I said before, Andoni in room number 4. We're going to break away. Go and grab your coffee. We're going to meet back here at 10:55. We did overrun there a little bit. We're going to try and catch up a little bit of space. Our next speaker is going to be Marius Reitz from Luno. We're going to be talking about the evolution of money and how crypto falls into this. So grab your coffee. Meet you back here soon. Okay, I think we're live again. Welcome back. I hope you got your coffee. I hope you joined some of the breakaway sessions that are happening there on the left of the screen. And we're about to start with the second part of the presentations that will take us through to the early stage of this afternoon. Our next speaker is Gaurav Nair. He's going to be talking about South Africa's first regulated cryptocurrency investment. Now, we heard earlier in the day how the crypto space is unregulated and how that's about to change as regulation starts to come in. It's not entirely unregulated, as we heard, but there are going to be much more specific regulations coming in. Our next speaker, Gaurav Nair, he's going to explain that South Africa's first regulated crypto investment is here and it's available. Gaurav is the co-founder of Geltec and is a market leader within the alternative investment market in South Africa and a growing player within the cryptocurrency market. That's Geltec we're talking about. Gaurav is a qualified actuary turned entrepreneur with extensive experience in financial services, which includes asset management, domestic and international corporate and project finance, capital structuring and raising, and hedging various financial risks and managing investments. Gaurav, are you there? Can you come online, please?
He'll be online in less than a minute.
Okay. Thank you for that, Keegan. Just a little bit of housekeeping notes here. I think we need a final session of the day is going to be tough questions around the crypto space. So start putting through some of your questions there on the Q&A, on the chat room, and some good ones coming through. For example, why does the arbitrage gap exist? Okay, we call it the arbitrage gap or the arbitrage premium. Why does it exist? And why is there this inefficiency between South African prices for assets and overseas? That's a good question we're going to pose to some of the presenters there. And the other question is this going to persist? Is the arbitrage premium going to be around for a while, or is it disappearing? And we already discussed how that has been constricted. It's been narrowing over the last number of years. We're going to see if our speakers believe it's going to be around for a while. Gaurav, oh, you're there. Good. Welcome. Gaurav, give us a sound check there. Can we hear you, please? It looks like you can't hear us. Okay. Keegan, can you sort that out, please? Gaurav, are you hearing us? You're not on mute, but you can't hear us.
I can't hear anything.
You can't hear anything. We can hear you.
I can't hear anything. Here I am. I mean, my camera's on.
Are you hearing us? You're not on mute, but you can't hear us.
Can't hear anything here. Use to refresh your browser, Control.
Okay, so while we're waiting for that that technical issue to get debugged, just a reminder to send through your questions on the Q&A chat for the final session of the day. The tough questions around crypto. It can be questions around tax, it can be questions around regulation, it can be questions around arbitrage. Who are the players in South Africa? How do you, and this is one that can be directed to Rand Neuner, how do you construct a crypto portfolio? Rand has done quite a bit of work on that, and he can speak to that. Will cryptos ever be recognized as legal tender in South Africa? I think that might be a good question to pose to the panel. It has already happened in El Salvador. It's recognized as legal tender, which then, of course, changes the whole regulatory definition of what is a crypto asset and cryptocurrency. Okay. Gaurav, how are we doing there? Logging in again.
Hello?
All right. Can you hear us, Gaurav?
I can. Can you hear me?
Good. We can hear you. Yes. All right. I have done the introduction, Gaurav. I'm not going to do it again, so I'm going to fire off to you. And I'm really interested to find out about South Africa's first regulated cryptocurrency investment. Over to you.
Thank you. I'm just trying to share my screen here. Struggling to share. There we go. So, sorry about the technical troubles. Presenting as first regulated cryptocurrency. However, I'm just going to talk additional space. Okay. Is that highlighted or is
Okay, I think we're having technical difficulties still there with Gaurav, and I don't know. Can we maybe debug that and see if we can get him online with a more stable connection? If that's going to take a little bit longer, then why don't we just rearrange the schedule here a little bit? Is Marius available? If somebody can just let me know if Marius is around, we can jump to that. Hi, Marius.
Hi, Kieran. How are you?
I'm fine. I'm fine. Okay. So due to technical difficulties, I think if we can just get your presentation underway. Are you good to go, Marius?
Yes. Thanks,
Okay.
Kieran. All
So
good.
let me just, for those who don't know Marius, Marius is, you might even call him Mr. Crypto in South Africa. He's the Africa General Manager for Luno. And he's well known to the African crypto community. Luno is a great South African success story, having grown to more than 7 million customers worldwide in less than a decade. And it's now headquartered in London. Marius, those figures are changing so fast, you might have to update us as to how many members you've got. But I know you hit the 7 million mark not so long ago. Marius joined Luno in 2016, and he helped the company grow to a diverse team of 450 people across 3 continents. He shares the company's philosophy of upgrading the world to a better financial system, and that means not just as a means of preserving and growing wealth, but making payments and transactions as well. So welcome, Marius. And you're going to be talking about the natural evolution of money and how Bitcoin and crypto fits into this. So over to you, Marius.
Thanks, Kieran, for the intro. As been said, my name is Raj. Just a quick intro. I work at Luno, and Kieran, yes, we've actually signed up a million new customers since I think 2 or 3 months ago. We've seen good growth. We've expanded across 6 continents. We've got teams established in most of those continents, but we're very proud of the fact that we have close to 400 people working at Lino in South Africa, between our Cape Town and our Johannesburg offices. But I'm not here about Lino today. I'm going to talk about Africa at large and how cryptocurrency potentially benefit as a concept. And before I do that, let's see my screen, my slides. Here we go. Okay, I'm going to take you back to the year 1996. And 1996 was quite an important year in the SA history. It was the year when our new constitution was adopted. And Thabo Mbeki at the time gave a very important title, I'm an African, where he spoke about the African Renaissance, and he borrowed some of the content there from a guy named Cheikh Anta Diop, Senegalese, who first started writing about the concept of the African Renaissance in 1946. And before him, a guy by the name of Marcus Garvey, who wrote a poem, the United States of Africa in 1924. And all of these people, intellectual heavyweights, and they all spoke about the same, they all, features or their philosophies there was one golden thread that connected them together. And they were all talking about how Africa can overcome its problems. Things around freedom of speech, dignity, individuality. And they all spoke about the importance of grouping, about collaborating, about working together as different nations to overcome some of Africa's problems. And I think this really started, and one thing that's very important and that I read on was that human progress at large, not only in the African context, is driven by collaboration, consolidation, and economies of scale. We have seen this many times in the past. Long ago, firstly, the creation of nation states, when people moved from living in villages or hunting by themselves to the establishment of nation states, where people again grouped together. We've seen this with urbanization, people moving to large cities to achieve economies of scale, to grow together as society. And also multinational companies such as Facebook and Apple, where people group resources to produce phones, goods cheaper and to achieve economies of scale. And I think a more recent example in the current context is during COVID, the global vaccine rollouts, and how many different countries collaborating to distribute vaccines and to roll out the global vaccination program. And I think it's really part of human nature. It's an inevitable part of society. And these three people, from an African perspective, realized this and they recognized this at a very early point. And later on, this concept of the United States of Africa Renaissance was also debated at an African level, and it was explored. And in particular, the concept around a currency for Africa. And I think it's important to realize that money is really no exception. A very important part of, for example, let's use the euro, for example, US dollar. When countries come together to do things together, to advance trade, to pull resources around thinking on a political level, certain economical policies, money is a very important part of that. It becomes integral to the thing because, simply put, it's a very important part in trade. Money is a very important part in transacting with each other. If you look at this slide and you look at the pink dot, you see that represents the fiat currencies as we know in today's form. And it's really been around for 50 years or so. And that's typically governments printing money or governments creating money and money as we know today. And if you look at the next slide, the global map, you will see that we've actually had common unions or for quite a long time, and actually have currency unions around the US dollar and green. You see the francophone countries in Africa using the West African franc, South African rand, and then one of the more well-known ones, the euro. If you look at this slide, 1792, that's the first time when someone issued government money. At the time, it was built. Although for us it's long ago, 2 years. If you look back over humanity's existence, it's really not that long ago. If you look back to 600 BC, that is when people first started to use objects or coins or silver coins to transact with each other. The point I'm trying to show you is that for most part of our existence, we've actually collaborated at a level. Actually, at a common currency, global currency, regardless of whether you were in South America and you traded with someone in Spain or in other parts of the world, gold coin or silver coin was a common accepted currency at the time. And as I mentioned, 2 recent projects, you can call them projects, the US dollar and the euro as well, just shows that when people together, they put resources, money becomes part of that. If you look at what a currency for Africa, and let's put crypto aside for the moment. Assume that Africa adopted the same currency. This is a very busy slide, so don't try and read the details, but just at a very high level, each of these blocks or tiles represent an important function that money fulfills across the African continent. And if you look at the first one, remittances, these figures, it's based on research done, very different, are performed. But more or less, if you look at remittance market in Africa in 2019, it was estimated to be $40 billion. And look at average remittance fees on that, roughly 10% of $1 billion in fees gone to intermediaries processing these remittances. Same can be said as $30 billion size market in Africa, or estimated by 2022. And then also other factors like financial inclusion. So many people across Africa are excluded from the financial system, and research suggests that as much as $1 trillion can flow into economies. Should people be allowed, and should people come online and people have access to financial system. Many other different things, capital controls, studies capital controls also suggested that if capital control is relaxed, intercontinental trade can potentially increase by 52%, and this is something that we learned also from the euro. And our trade different markets in the euros just increased as people started to adopt the common currency in Europe. So look at technology, and the thing about technology is that all the savings typically go to consumers. So using very, very simple examples, don't have to pay postage anymore to send a letter. You don't have to incur exorbitant fees to call or the US with a landline. You don't have to call only during certain times of the day because it's cheaper. Then you just really just use technology, and you use WhatsApp, a WhatsApp call, and you incur a couple kilobytes, maybe megabyte in data charges. So all this value that all the fee value that I showed in the previous slide, and I mentioned which is something that's very across Africa, and that's things like fraud with credit cards and unsafe payments. Now, all this value really goes to the end consumer. Sure, there will still be intermediaries, there will still be companies acting as trusted platforms in some events for the next 5 to 10 years. But the pie will become much, much smaller, and most of the value will end up with consumers. So just staying on this, so how does crypto fit into this? I think, looking at an Africa level, it's very difficult for government to build these things and to collaborate if there's no political will. And fair enough, some countries are simply stronger than other markets. Some countries are based in ridden areas, so it really makes it difficult to develop fairly. And there's no, simply put, there's no incentive for 50-odd African states or countries to really work together to make this work. So I think what we're seeing and what we've observed from the US perspective, having been active in the African market, in SA since 2013 and in Nigeria since 2015, is we're seeing growth from a grassroots level up. We're seeing people, especially in markets such as Nigeria, African countries, where people find Bitcoin useful because it solves a specific need. It solves a specific need that the current options or the current financial system is able to meet. Then they will all gravitate towards the solution. So I think with crypto, we're seeing something that's neutral, based on something that everyone can use, and there's no debate around, whether one country is stronger or better than the other country or not. And I think something else that makes it interesting is its versatility. And I think we're also seeing, and that speaks to the fact that different purposes. Some people use cryptocurrency for payment. Some people use it as an investment, and for many other different reasons. As we've seen, crypto lending, people having the ability these days to put on crypto as security to obtain fiat denominated loans. So we're seeing many different use cases come to the fore. And I think we're also seeing more stable versions of cryptocurrency. If you look at some of the challenges that still have to overcome. So we see, from a payments perspective, we're seeing stable coins, cryptocurrencies backed by traditional currencies, baskets of currencies that make it more suitable or better suitable for payments. And same on the investments case, we see crypto tokens that's backed by a basket of commodities even, that makes access to that easier. So our view is that a new financial system will be built from the ground up. And we've actually made a lot of progress looking back over the last 5 to 10 years in doing so. This is not going to happen overnight. We're not going to suddenly see a shift towards cryptocurrencies overnight. And although we're seeing crypto in the media, we're reading about it in newspapers, we're seeing it on TV, at the Formula One and many other sports events these days, and there's a lot of hype to talk about. We're still very, very much in the early days. And we at Luno think that we're still in the asset people, predominantly the cryptocurrency market, seeing crypto as an investment. And I think that's where the mindset starts. That's where people start to think differently about money. And once they know what they can get. And yes, as we discussed, the transaction phase will also, or crypto for transactions will also be very, very important. As 2 slides ago, all the value that can unlock to consumers, $4 billion in remittance fees being paid to intermediaries. I think we're just not there yet at this point. I think people buy crypto mostly for investment purposes at this point, and for many different reasons. As some of the experts on this we'll see later on. And so, for many different reasons, Bitcoin is digital asset. People view it as a hedge against future inflation. Now, other people think that crypto will become more integrated into the financial system. It will play a more important role in how we transact in the future. They assign a dollar value to that, and they take a longer-term position. But the interesting part on the transact phase is people buying Bitcoin as an investment asset. Now, when they get the opportunity down the line, for example, to use Bitcoin to go on your favorite media outlet, on Bloomberg, for example, then they will most likely use that. I think that we will build up a critical mass of people that we need to really use crypto for payments. Then the last phase is a decentralized phase. That's where we don't, in simple terms, need or use intermediaries to access financial services. While that's a very important phase, very interesting phase, I think the current problem is that people will need crypto to access DeFi, to access decentralized finance. And the current problem still is, especially across Africa, now, if you look at markets like Rwanda, Malawi, even more developed countries like Egypt, and even in South Africa, it's still very difficult for the average person to access crypto safely. So we think that there's still a lot of work that needs to go into building the infrastructure across the African continent for people to safely access crypto in order to participate in this economy that we find ourselves in. So where do crypto exchanges like Luno fit in? People often refer to crypto platforms as cowboys, and I think we agree to some extent that yes, we are cowboys, but this isn't necessarily a cowboy. Bandits force people that comes to your head, and one thing that we need as a crypto platform and in SA is that we are not forcing crypto down anyone's throat at all. We think that any tech revolution, any technology revolution, growth will be quick, and it is going to happen. And we are just to tame that, and we're just trying to make it easy for everyone to access cryptocurrencies in a safe and secure manner. So if you go back to 1996, the year Thabo Mbeki, that speech, and we look at mobile phones, people that owned mobile phones in 1996, probably something like this. It was a big, clunky thing. It was difficult to, move around. In Africa, in particular, less than 1% of people at the time owned a mobile phone. So in other words, the penetration was less than 1%. And it wasn't really useful because your supplier didn't have a mobile phone. So why would you have a mobile phone? Why would you use it? There wasn't a net positive or net benefit to society. But 25 odd years later, we've seen in sub-Saharan Africa more than 90% mobile penetration across the continent. And I think ironically, the mobile phone perhaps did more for, when Thabo Mbeki made a speech in 1996, he spoke about a lot of topics, freedom of speech, democracy, human rights, human development. But ironically, the mobile phone more address those systemic problems across Africa than any politician in any parliament or any government. But if Thabo Mbeki said this in his speech in 1996, the role that the mobile phone would have played, people would probably have laughed at him at the time. So I think the message I'm trying to say is that a lot can happen in 20 years. We believe that innovation on a level may be inevitable. We think it's already happening right in front of our eyes. Thank you very much.
Thank you, Marius. A question that bothers me a little bit is this whole question of money. What is money? How do we define it, and how does Bitcoin fit into that? And you discussed it quite eloquently, I think, how the whole payment system in Africa is just ripe for this kind of disruption. You still there, Marius, or have you've disappeared?
I'm here. No, I'm here.
You're still there. Okay.
No.
If one looks at people like Michael Saylor, who's the CEO of MicroStrategy, his company's invested $2.2 billion in both cash and loans into Bitcoin. And the reason that he's done this, and he's laid this out, people can go and look on YouTube and see what his thinking is, that he just perceives, looking 10 years down the road, that the value of money is going to continue to depreciate because it's in reckless hands. I think his words they use, I'm actually being kind. I'm not being unkind. reckless hands, meaning that the rate at which fiat money is being printed into circulation is frightening. And anybody who's looking to protect themselves against that will be looking for some alternatives. Do you think, and are you seeing any adoption from companies, chief financial officers, CEOs in South Africa who are alarmed by what they see? Because if the problem is bad for the US dollar, it's worse for the rand. Do you see any adoption happening amongst companies in South Africa?
Yeah, we see lots of interest. We've had discussions in South Africa with financial asset managers and with other corporates. We've not really seen any corporates take action like we've seen in the US or in other parts of the world, and actually putting crypto into their treasury and holding on to crypto. And I think it's mainly because some of the challenges we're still facing in emerging markets like Africa have this level of sophistication. It's like regulating the US a couple years ahead of with license regimes. We don't have that. We don't have the same level of trust in South Africa. So, companies, a mass market retail platform focused on individuals, we're simply not able to manage $20 billion of once-off over-the-counter deals with large institutions. For that to happen, we need better infrastructure. And I think that the exciting part is that companies invested have been looking at this, and they're building their own custody solution, which will be catered towards large institutions. So I think as soon as we have the infrastructure in South Africa, Kieran, and as soon as we have, I think the first trigger will be regulation. As soon as that comes to the market, it'll definitely insert a bit of trust. If you look at banks, they've got track records of 100 years to trust them. And the same cannot be said for cryptocurrency platforms at this stage. We have to earn trust from clients. So regulation will be a trigger. We definitely see lots of institutions in SA on the sidelines, but we just don't have the same level of infrastructure and sophistication of infrastructure regulation in SA at this point, compared to the US and Europe.
All right, Marius, thanks very much for that. We're going to move on now. We had a little bit of technical issues with Gaurav Nair earlier, and I believe we have that sorted out now. So if we can, let's see if we can get Gaurav online again, please. Okay, so you can come out. There you are, Gaurav. Have we got you this time? And is it stable?
I can hear you. Can you hear me?
Yes, we can hear you. Okay, so just very briefly to reintroduce you, Gaurav Nair is co-founder of Geltec, which is a market leader in the alternative investment space in South Africa and a growing player within the cryptocurrency space. Now, Gaurav is a qualified actuary turned entrepreneur with extensive experience in financial services. And I'm very keen to hear about South Africa's first regulated cryptocurrency investment. Gaurav, over to you.
Thank you, Kieran. Let's see if we have more luck with the technology this time. I'm also very excited to be presenting this. If you could hear me earlier, apologies for retreading some of the same ground. The first thing I'm going to do is just lay out some of the differences between cryptocurrency assets and services and those in the traditional financial system. And the reason being that it'll explain why we made this product and how it actually helps. So to talk about some of the things which Professor Monica Singer had talked about earlier, there's many differences between the traditional and crypto space, and the list is very long. I'm going to focus on the first 2 points on this list, being trust and regulations. Now, when it comes to trust, we often don't realize that even with the simplest of financial services, we actually have to trust the financial institution.
All right, we've lost you there again, Gaurav. Okay. Keegan, we've lost Gaurav there, so can we try and get him back on again? In the meantime, I'm going to remind you that we are waiting for your questions to come through for the final presentation, which is going to be tough questions around the crypto space. The real tough ones. Questions around crypto regulation, around taxation, around who are the providers in this country, and maybe even, you know, who are the how do we separate out the scamsters from the good hats, the white hats from the rest? And I think that's going to be a challenge for South Africa as we go into the next couple of years. South Africa has the unfortunate reputation for being a home for some of the most terrible and terrifying crypto scams in the last few years. And so I was quite looking forward to hearing about the first regulated cryptocurrency investment from Gaurav, and hopefully he's going to come back online in a minute so we can continue with that. And I think regulation is something that is happening. There's a story published up on MoneyWeb today about the formation of a voluntary crypto association amongst players in South Africa. And the reason for that is two things. One, to form a united body when it comes to regulators. You know, if you don't speak with one voice and align your interests, then there's a chance that, you know, you end up with irrational regulations, and we don't want that to happen. And the second thing is better sharing of information, so that when you have a mirror trading scam like we had in South Africa over the last couple of years, that people can be alerted to this. And I think members of the public, and we certainly noticed this at MoneyWeb, writing to us and asking us, you know, is this crypto investment scheme good or bad? It's very difficult to keep on top of all of this. The point being that the better information that is being shared between the crypto asset exchanges, then the quicker we can sift out the bad hats from the good hats in South Africa. And I've just got a reminder here, there are some polls. If you click on the polls on the right side of your screen there, let's just see what we've got here. No, I don't see it. Okay, how are we doing there with Gaurav? Any progress? And if not, can we move on to the next speaker, please? Keegan, are you there? Can you give us an answer on that one, please? Can we move on to the next speaker? Or have we got Gaurav coming back online? Apologies for this, technical issues. We're trying to get Gaurav back online.
Just apologize on Sunday night.
Cool.
Gaurav, you back?
Yes, I am. Can you guys see me and hear me?
Yes, we can. So why don't you pick it up from where we left you?
All right. Okay. Let's try again. Maybe third time lucky.
All right.
Okay. Let's just share the screen. There we go. All right. Here we are.
Okay. I was talking to, I guess, the way that we
Trust financial institutions and how this is totally unnecessary in the crypto space. Secondly, the traditional financial institutions are regulated, which is probably why we are comfortable trusting them in the first place. And not to contradict Professor Angela Itzikowicz, but the crypto space is often unregulated. Yes, functionally, it might be captured in some of the regulations. However, there isn't someone checking that the investments are sound. There isn't someone that you can complain to if something is wrong. So just exploring both of these topics in a bit more detail. Being trustless requires quite a bit of work on the part of the investor. Even if you as an investor are very comfortable with trading, for example, listed shares, there are different skills that are required when buying and selling crypto assets. Secondly, even after one manages to do that, taking care of these crypto assets involves a totally different skill set. There's a concept known as private keys, and the person with the private key owns and can control the crypto assets. And if these private keys are lost in any way, if your computer crashes, if it's hacked and stolen, if you write it down and it's destroyed in some way or lost, what a lot of people don't appreciate is there is no way to actually get back your private key. There isn't any forgot password link, and now you just fill in a new password and you're back to where you were. And it's estimated that in this way, 20% of all Bitcoin issued to date has been lost, which is a staggering value of up to 2.2 trillion rand. And then there's risk mitigation around all of this to make sure that whatever you're doing is happening safely. And to just take one example of this, in the event of someone dying, their heirs may not know where they have their cryptocurrency stored, how to manage it themselves. They may not have the skills and knowledge, etc. So this involves setting up systems and processes in your life that you may not be used to. And then there's an ongoing requirement to maintain your knowledge, skills, systems, and processes. But the reward is that it results in certainty. Now, because cryptos are often unregulated, what this means is that the asset class can move very quickly, and there are things that the asset classes can currently do that can't even be done in the traditional space. That being said, it being unregulated means that a person needs to do a lot of research and reach comfort themselves about the underlying asset they're going into. How sound is it? Have there been any security issues, etc.? And further, an investor needs to be self-reliant because they know that there's no regulator that they can go and complain to who can impose penalties or make things right for them. And for these reasons, many investors who are interested in investing in this space, they can't get any advice or any intermediary services. Their financial advisors are not willing to give them advice. And that's because currently through FSCA, even though it's being proposed, it's unregulated, the financial regulations. From an advisor's point of view, advisors often they have a desire, some of them, to allocate a portion of their clients' portfolios into crypto assets, or the clients are asking them about allocating some of their portfolio. But as advisors will appreciate, there are no license categories currently under phase to invest into crypto. And so this leaves them in a position where they don't know what risk they're taking. And where clients don't have the ability to keep custody of the crypto assets, advisors don't want to custody it themselves either. And so this leads to many investors being locked out effectively of this innovative asset class. Now, even corporates and financial institutions like pension funds or fund managers, they also find themselves unable to come in. A lot of their investors and traders and etc. don't have the execution skills we talked about. Also, private key management is something novel for them to deal with. And they can't just, for example, give the private key to the CFO. It could be a huge amount of value, and that entails a lot of risk. Within companies and institutions, there are also authority frameworks. And these authority frameworks are, for example, that in a company to release a payment, 2 people need to release a payment. And if the amount is a bit higher, then a manager needs to sign it off. If it's even higher, it goes to the board, etc. Crypto assets and systems often don't gel with what companies and institutions currently do. We also rely a lot on our financial service providers to prevent fraud. If there's a suspicious transaction or a weird-looking signature, they might flag it or freeze it and do further checks on our behalf. And finally, companies and institutions don't know how to value these investments. They don't have that expertise, and they need that to account for it and ultimately to report to investors.
Lost you, Judy.
Again.
Go to my Wi-Fi.
Okay, I think I'm back on. Okay. So there are many great products out there in the cryptocurrency asset class. However, what we find is that a lot of the user interface to actually deal with this is very difficult for people, and it requires quite a bit of skills that they don't necessarily have dealing with the traditional space. It doesn't plug into the systems and processes of companies and institutions, and even the systems and processes that we as individuals have in our lives. And to get there, it requires a huge time demand. There are companies like MicroStrategy out there that have built out all these systems and processes and published all the information. However, most people are not financial experts. They are not necessarily focused on crypto assets. And so they don't have the time to build out all these systems and processes and upskill themselves. So this goes even more so for companies who are just focused on doing their business very well. And so what's needed is a traditional interface that'll provide access to this crypto asset class. So what is Jaltec's answer to this? Our answer to this are our cryptocurrency nodes. We've created 3 different cryptocurrency nodes, one that gives exposure to Bitcoin, one that gives exposure to Ether, and one that gives exposure to a diversified index of cryptocurrency assets. And investors can choose if they want to invest in one or a combination of 3. How it works is that today, if one invests 100,000 Rand into the Bitcoin note, and then Bitcoin goes up 50%, when the investor wants to come out, that note will redeem for 150,000 Rand, less any applicable fees. So the liquidity that we provide on these nodes is 1-day liquidity during business hours, meaning that if you want to redeem your note and get out cash, that one business day later, we will process that payment. There's a minimum investment of 10,000 Rand once the offer is open, which is a bit later this month. And behind the scenes, we have done all the hurdles that we've talked about. We've created all the systems and processes, providing professional execution and providing institutional grade custody. Now, a bit about the index for investors who are looking for diversification. The index, the Jaltec Large Cap Index, is the largest coins and tokens by market capitalization. However, we've imposed minimum diversification benefits because Bitcoin and Ethereum are such a large part of the ecosystem. If one wants diversification, we've capped those at 30% each. We have no stable coins. The reason being that the stable coins, while some of the largest, their aim is to maintain a certain value, often $1. And so there's no opportunity for growth by holding stable coins. On top of this, we impose 2 metrics. One is historical metrics and the other security metrics. So historical metrics are specifically to make sure that any coins that are in the index aren't a flash in the pan, so to speak. We know that the crypto space is very volatile and a coin might rocket up and become a very large coin, only to drop later on. And so to make sure that the coins included in the index are sustainable, we would look for a certain market capitalization, liquidity metrics, and trading metrics over a sustained period of time. On top of that, the security metrics, we make sure that the coin is decentralized enough, and secondly, that there aren't any known security exploits or there aren't any security exploit suspicions. We rebalance this quarterly, or if there are large moves and the weights are now in the index now don't reflect the market cap, or if there's any emergency security breaches discovered. Currently, the index has 8 coins in it based on these metrics. It's from largest to smallest, Bitcoin and Ether capped at 30% each, and then Binance, Cardano, Polkadot, Uniswap, Chainlink, and Aave being the smallest light blue sliver. Now, we've talked about this being the first regulated investment. So what regulations? Well, because the space is unregulated, a lot of product providers out there, they quite enjoy that it's unregulated. However, this doesn't give investors peace of mind. So we have voluntarily sought out regulations. Firstly, the company issuing these notes, we made it a public company, and this is a public offer with a SIPC-approved prospectus. Now, what this results in for investors is higher levels of transparency and accountability because public companies are subject to more checks and balances. Furthermore, there's additional governance by an independent controlled board whose focus is only the well-being of investors. But most importantly, what we've done is we've structured this investment to be classified as a debenture. Debentures are just unsecured debt. However, this allows financial advisors to advise on the product. We've got a professional legal opinion that the phased license categories would either be securities investments or the subcategory of debentures. And many financial advisors out there have this license category. So this brings it within phased regulations, and it allows the financial advisors to do the due diligence and the work on behalf of investors, and then to be able to sell this product. And investors then can enjoy advice and intermediary services of the people they trust. Of course, if investors want to come direct, they're also able to do that themselves. It should be noted, though, that advisors that want to sell this product should have a working knowledge of underlying cryptocurrencies, because that is the ultimate exposure that the clients will have. Now, there may be an objection that why wouldn't an investor just go direct? Why actually go into these Jaltec notes? They could avoid some fees, in fact. And there may be other objections that, well, cryptocurrency should be trustless, but now people are just trusting Jaltec. Well, there are many reasons why the Jaltec notes provide a better value proposition than going direct. Firstly, as mentioned, we've built up the execution expertise and this background, ensuring that investors get better prices in their exposure to the crypto notes. Obviously, it's much more for investors who like the asset, want to get into it, but don't have the time to do all the research and upskill themselves and build all the systems and processes in their lives. From a security point of view, as I mentioned, Jaltec has built up institutional grade custody to house the assets and all the systems and processes around that. The Jaltec notes are easy to bring into one's estate planning, as the notes go into the estate and there isn't an obligation on the heirs to now have the same level of skill, knowledge, systems, and processes in order to receive these assets. It is regulated, and the sales channel now, we can use a regulated sales channel for you to access this. And through the Jaltec Large Cap Index node, there's package diversification built in. This results in know-how, peace of mind, and ease of use compared to going direct. Now, there are many reasons that people put forward to invest in cryptocurrencies. There are also many reasons that people are afraid of it. However, there's one reason which doesn't involve having to know the future and which doesn't involve your view of the future. And this reason is indisputable, which is that cryptocurrencies have asymmetric payoffs. What this means is that if you invest, let's say, 100 Rand into cryptocurrencies, the maximum you can lose is that 100 Rand. However, the maximum gain potential is really uncapped, and we've seen astronomical returns already historically. That number can go up to 2,000, 5,000, 10,000, can go up to any number, and your profit is much more than the 100 Rand you potentially stand to lose. Your view on how likely that is a different matter, but no one can argue that the payoffs are asymmetric. And I've got an example here where you compare a portfolio that has no exposure to cryptocurrency that grows at a steady rate. After 4 years, it's worth 146 Rand. If one had allocated 2% of this portfolio to cryptocurrencies and somehow it goes to zero, that allocation, 4 years later, one is at 143 Rand. So, a very slight difference. And the bottom two bars show that. However, if it does 20 times, which it has far outperformed in previous years, it ends up being 40% of the original portfolio and far outperforming the portfolio with no exposure. So that's just a demonstration of the asymmetric payoffs. And that's my presentation today. I'll now take some questions.
Thank you. That's interesting. I have a question before we open it up to the floor. I'm curious to know about how so you've got 8 coins in these notes, these Geltec notes, and it's a very compelling proposition. So you're kind of going the grayscale model where you're providing an indirect way for institutional investors to gain exposure to cryptos, but it comes with institutional grade security. You get better execution, and you also get some curation of the crypto assets involved. Now, that's what I'm concerned about. I'm not really concerned. I'd just like to know your logic behind it. For example, I see you've got Cardano, you've got Polkadot, you've got Uniswap, you've got Aave, and Bitcoin and Ethereum. How did you come to those?
Yeah, so we do want to take out as much of the discretion as possible. So that's why our primary metric is the largest cap. But you would have seen on there isn't a Dogecoin on there, for example. So we then actually filter by certain metrics that would disqualify coins. So we're more about what are the largest cap, and then take out the coins that are disqualified. And our disqualification criteria is around where we think it either fails on security metrics. So with Doge specifically, our debates at the index committee was around the centralization and not having peace of mind that the coin is decentralized enough that that'll be a safe addition to the index. We also make sure that there's enough liquidity. And so we look at various exchanges, what's the market cap been over a historical period, and what the liquidity is over a historical period. And so in that way, we actually remove coins out as opposed to selecting coins in. So that for investors, even if they don't agree with our view on which coins should go in, at the very least, they get exposure to the whole market, minus the coins that have questionable security or history.
Okay, and then on the security side of things, have you outsourced your security? Is it something you developed in-house? I imagine it's probably easier to outsource it, right?
That's right. So we are using some of the best institutional grade custody in the world. However, that being said, there's a lot of systems and processes that have to be built in-house. So even if you go to a third-party custody provider, it requires the management of multiple keys. It requires keeping these geographically separate, etc. There are many aspects to bring in best practice. And then it involves being able to create backups of those keys that don't compromise your security. So with respect to the technology, we're using some of the best technology in the world, and that's outsourced. But then we've built up inside the business the best practice of security measures in how we actually manage that on an ongoing basis.
Okay, and this is going to be launched later this month.
That's right. That's right. Later this month, we'll be opening for investments. That's correct.
And it's called the Geltec Notes. Is that it?
That's right. The Geltec cryptocurrency notes. Yes, there are 3 notes.
Geltec cryptocurrency notes. Okay.
That's right. There's one that's specifically focused 100% exposure to Bitcoin, 100% exposure to Ether, and the third note is the index.
Okay, so you've actually got 3 notes that are being issued. One focused on Bitcoin, one on Ethereum, and an index comprising 8 constituents.
Exactly right. That's right.
What has been the feedback from the market? You obviously surveyed this. What response have you got?
So yeah, I guess there's been two areas of feedback. One is people that are very comfortable with crypto assets. They ask the question, why should I come through you? And they see less of the value proposition, but this is a minority. For people who are comfortable custodying their own assets and with execution and so on, then it may not make sense for them. But for the great majority, has been a huge sigh of relief. There are people who have been watching the crypto space growing. They want to dip their toe in, but they don't know enough, and they want advice and so on. They can't get the advice. Or there are people who are more knowledgeable, but still cannot actually build up all the systems and processes and infrastructure. And so there's actually been, for them, there's been a great sigh of relief saying, okay, this is a way I can get in. This is a way that I'm used to dealing. And they just want to understand what our systems and processes are and how we ensure the safety of the assets that we are taking care of for them.
Wow, interesting. Gaurav Nair, thank you so much for that. I'm sure that people can reach out to you in the breakaway session rooms if they want to know more about that, or they can reach out to Geltec, info@geltec.co.za if they want to know more about that. So we're
That's
going to
right.
leave it there. Thank you, Gaurav.
Thank you, Kieran.
Okay, we're moving on. The next one is interesting. This is a fascinating subject. And if, like me, you had to rush off to your dictionary to understand what the word fungible means, you'll have an idea of what our next topic is about. Non-fungible tokens, or NFTs. You probably heard this word thrown around, or this acronym thrown around. So we are going to welcome Dr. Merav Ozer, who is going to talk about this subject and explain, hopefully, what the word fungible means. And do we have Dr. Ozer lined up to come online? Before I go into my introduction. Well, I suppose I should share my discovery about the word fungible.
Yes, I'm here.
There you are. Okay, Dr. Ozer, welcome.
Welcome.
I was just about to start my introduction, so let me do that. And I hope that you're going to explain what the word fungible means for us all. Are you going to do that?
Yes, I'm going to do that. And let me just pull up my presentation, and I'm sure that everything will look
okay.
Okay.
While you're doing that, let me do an introduction here.
Okay.
And so Dr. Ozer is a data scientist. She is a quant strategist and a leading blockchain and cryptocurrency expert. She is a fintech faculty member at Rutgers Business School, where she has developed and teaches courses on blockchain and digital assets for both undergrads and graduates. And she also serves as research director at Rutgers Business School Blockchain Hub. She's an advisor and researcher at the Rutgers Blockchain and Fintech Collaboratory, and is an affiliated professor at Rutgers Law School, focusing on DeFi. My God, that is a powerful CV, and there's more to it. So let's welcome Dr. Ozer. And the subject, of course, is NFTs, non-fungible tokens, explaining their relevance to the investment and finance industry. So I'm looking forward to this. Over to you, Dr. Ozer.
Thank you so much, Keegan. I really appreciate this lovely and very introduction and your kind words. And thank you, everyone, for having me this afternoon. It's afternoon for you. Good morning to me, very early here this morning. And I'm going to, and thank you for joining me today for this very exciting topic about NFTs and how it's going to change the business world. And I can tell you it's not just going to change the business world, it's going to change your life, because blockchain technology is going to be the rails, what I call it, that's going to, all the services and the products that you know today are going to run by blockchain technology, and NFTs, which is one application of blockchain technology, will be utilized in one way or another in any service and products. So I'm very excited, because this is the future, and the future is very exciting. And I hope that you will be a little bit excited as I am by the end of my presentation. So NFTs stands for non-fungible token. But let's understand first, what does fungible versus non-fungible means, and I think you can just mention that, what is in fact that concept. So let's start from what the understanding what fungible versus non-fungible mean in general, because the idea of fungible versus non-fungible has been around since the beginning of time. And let's think about what is fungible versus non-fungible in the physical world. So in the physical world, when we think about fungible is anything that is interchangeable and sometimes also indistinguishable. So if you think about this $2 bill, this is, I'm in the US, so I'm using a US dollar, but you can think about any payment that you use today, whatever you use in South Africa or anywhere in the world. So these $2 bills, they are interchangeable. Why? Because it doesn't matter which one. If I go to buy something at the grocery shop or buy coffee, so the person at the store, accept, whether this dollar or that dollar, now it is interchangeable, right? They don't care. However, it's not indistinguishable because it has a serial number, and the serial number is how the central bank track it. So this is what I mean by fungible. And when we think about indistinguishable, so yeah, this is grains of salt. So you can think about these grains are interchangeable, but also indistinguishable because you really can't really make a difference between which grain you're using, to dress your salad, for example. So this is just to understand the fungibility aspect of it. Now, if we go to understanding, what non-fungible means, non-fungible is anything that is unique. So unique, everything that is unique in the physical world can be like an action movie, could be a painting. Like even if we're talking about painting of Rembrandt or Picasso, then even each and every painting of Rembrandt or Picasso is unique because it's not interchangeable. And back in the days, we used to barter, or one goat for 2 cows, but still, a goat and a cow, that they are unique, and then to figure out the value and how to really barter between them, then that's probably was very subjective, but that's the idea that we can think about everything that is unique in the physical world, whether whether it's a painting or a video. This video, for example, you as a human are unique. I want to believe that we are all unique and we're all different, and so everything that is unique is non-fungible. So now if we take that to the tokenization world, right? So the equivalent or the analogous to fungible is Bitcoin, because it doesn't matter, which Bitcoin you use when you transfer it and pay for it. It doesn't matter. But it is not indistinguishable because it's like the dollar bill that I just showed you. It does have some kind of, not exactly serial number. It has a hash number, so it has a way to distinguish it. So it is interchangeable but not indistinguishable. However, when we're talking about non-fungible, then every digital art, the Beeple, you probably heard about the Beeple collage that was sold for $6. I think that was, the most expensive NFT that has been sold as of yet. We don't know what will happen next, but that was the most expensive. I think expensive one. So this is so if this is a piece of art, a digital art, but it's unique. You can think about whether it's Dorsey. When Mark Dorsey, the CEO of Twitter, just also sold his first tweet, which is just 3 words, this is the first or something like that. And that was sold for $2.9 million. So everything that is unique, that you can think about it, you can even NFT yourself if you really, have high esteem of yourself and you think that you should be NFT'd. So that's what we mean by NFT. It's non-fungible tokens. So we are taking it, we are tokenizing it. It is a digital form and we are tokenizing it. So it's a unique token. That's how you can think about it. A unique digital asset. That's the best way to think about it. And the concept of NFTs has been around a long time ago. Even though the hype just started now, and it's as if it just happened. But in fact, the first NFT was created at the end November of 2017. And it was called CryptoKitty. It was a game, and you can think about a kitty, or you can think about any animal is unique, right? So the idea was that you have a kitty, you create it, it's a digital kitty, and you can breed it, you can sell it, and that's the idea of that. So the concept has been around a long time ago, but I guess people forgot about it because of the bust of the crypto market, as we know, the end of 2017, and since there, things kind of like people forgot about it. But it's kind of like got a new wave, a new hype. I think, during the pandemic, people probably had too much time on their hand, and that, came back to life, so to speak, and in a big boom, which everyone is talking about. So yeah, Dapper Lab was the one who created this crypto. Credit is still around. They're doing really exciting stuff. They're building, in fact, the platform for NBA NFTs, which is a basketball association, was created with the NBA associations. Will Dapper Lab created that Top Shots marketplace for NFTs for all kinds of NBA athletes, etc. So just to give you some idea. Okay. Now, people always ask, why do they exist, right? Why NFTs? But you can think, as of now, that the main purpose, the main usage of NFTs were in collectible, like the Dorsey tweet or what athletes are doing, etc. So you can think about, there's any collectible. Why do people, collect? Because either I own it, some kind of or think about it as an investment. And if you collect in the physical world, whether it's paintings or wine or jewelry or whatever, then now this is a new medium that we everything is digital today. So now the concept has become more in a digital world. So this is how you can perceive that today. And again, we think about uniqueness, we're thinking about a sense of ownership and pride. And so you can basically, in the digital world, you can basically digitize almost everything from something physical and you create a digital representation of it, or something that's also already digital, like a tweet or video, or even an article, anything that you can create digitally, you can NFT that. Now, people are always asking, is that a bubble or not a bubble? But let's be honest, whenever we think about a bubble, we always know about that in hindsight. While we are experiencing it, people may guess, yes, it's a bubble, no, it's a bubble, we don't know. And, and the value of anything, depends, on what will happen. And like any investment, whether you invest in real estate or invest in the stock market, it's everyone guess about what the value is. Some people, have, their own models and understanding or not understanding or just guessing and gut feeling, so to speak. And they investing in one thing or another that may become 2 times more and maybe 100 times more in the future, and may go bust. But we don't know that, and that's like any investment, you have to be mindful of that. So if you think about NFTs as an investment, not as a collection, because you really feel that this is something that you would like to own from a personal perspective, then you should approach it like any investment. You should ask, who is the creator of these NFTs? What is the potential to increase in value in terms of reputation of this creator, the rarity, the ownership, etc. So all of these things, like in any investment, you can think about the auction, because they're all, it is traded in all kinds of auction platforms. So you can think about, which auction platform to use. Is it tradable? Is it liquid? The liquidity issue is also an issue today, especially, but who knows, maybe in the future as technology advances, then this liquidity issue probably will be less of a concern. But this is another thing that you should think about. And from a taxation perspective, it is subject to taxes. In anywhere around the world, even though the regulations are not there yet. From a regulative perspective, regulators haven't really wrapped their head around NFTs. However, the tax authorities are always coming first because they need to collect in payments and taxes. So from the creator perspective, this is an income tax, and from an investor perspective, it is subject to capital gain because it is an investment token. So that's something to consider as well if you decide to go that route. Now, but there is something that is beyond beyond the what you call investment and monetary value. There is also some kind of something more on a personal, emotional value, because you can have an NFT and you can add to that what we call utility. And the utility is something, like what, there was an NFL, what we call football, the US football, not soccer, football in the US. And with this, photos of his, he also created, some utility, which is, a meet and greet, and one, and some VIP tickets that you can join his beach party that he's having, and things like that. And another example for that, the music band Kings of Leon, they also released their album as an NFT. Remember, it could be music, can also be digitized. And they gave whoever as an auction the opportunity to bid on 6 golden tickets, and that will allow the buyer the front seats for life. So there's all kinds of perks that you can throw in, what they call the utility that will do the NFT. So it has sometimes more than just a monetary value, but also maybe some personal, emotional value. If you like this, whether an athlete or a band or a musician or an artist, it throws another value to it, which is beyond just monetary. And if you think about it, just want you to think about, maybe we can discuss this later on in the Q&A, is like, what if you can, basically the ticket itself, you can NFT it. Just think about it this way. I'm just throwing it out there that, as of now, it's a ticket basically is a piece of paper, that you purchase it, or it could be digital, and you basically ignore it, after the concert, or either you throw away this piece of paper, or you just, don't care about it. But what if we can NFT it? So if it's NFT, then it can stay there forever, and then now it becomes an asset value. It can become a collectible. So just think about it from that perspective of what can you do, which is beyond just, selling tickets. So these tickets can not just be for this auction of front row, but it can be for every ticket, can have a value, maybe not like the front row, but just think about it, throwing it out there. Okay, so this trend is definitely going to continue, because the possibilities and opportunities of NFTs are boundless, and goes way, way, way above and beyond art and celebrities and tweets and photos and all of things digital. Because the business applications, this is what you have to pay attention and focus on, are vast. And the true power of NFTs is basically the authentication of any asset, whether it is physical or digital. And by that, when you authenticate, because every transaction that we have starts with the authentication of anything. And the power of NFTs is this authentication, and by that you facilitate basically any transfer of any ownership for any property. So the properties that you can so that you can authenticate are anything from physical to digital, as I mentioned. And if you are authenticating a physical asset like real estate property, so the value of that NFT will be tied to that physical value, this physical asset, like in the case of real estate, for example. And when I mentioned, that you can basically, NFT anything, wine or a Gucci bag, just, in fact, Gucci did NFT a bag, and, surprisingly or not, the NFT bag, the Gucci bag, is worth more than the physical bag. Just a thought why that could happen. So, and then, if NFT is an asset, then you can think about, you can take it a step further, and you can think about all the other things that you can do with NFTs. And if it is an investment, It can also be used as any financial vehicle, let's say for collectible. And today, with all the new decentralized application, the decentralized finance applications, it can be used whether as a collateral or for lending or provide some liquidity in all kinds of liquidity pools like that we see today. So the applications are really can go way above and beyond what we can think today. And so basically the idea of NFTs, everyone can create an NFT. It's not. It can definitely democratize society, and that's what I believe that will happen. And today we hear about all the celebrities that are NFTing their whatever piece of art or a tweet or something like that. But it can go beyond that, and everyone will come to a point. And I think there are some platforms thinking about it this way, how to really make it easy and seamless for everyone to NFT, and so everyone basically can monetize whatever and create new income streams. So you can think about, instead of you just posting your video or I don't know, your ideas about some lessons that you created about I don't know, cooking or some recipe that you have, then and putting it out there on Instagram or Facebook, then instead of doing that, you can NFT that and monetize it right away. So that's another way of thinking about it, and this is how you might be able to create some additional income stream. And in that sense, I believe that that will come a day where it's really going to democratize society in a way that everyone will feel that they can monetize, whether it's their hobbies or any sort of additional income, source of income. But it can go even beyond that, because as I said, it's the business use cases that are important, and you basically can NFTs, any certificate, because authentication is what's important here. And the manpower, and this is something that I want people, if there's one thing that you should remember from this presentation, is that the manpower of NFT is the authentication. And if you think about it, every transaction, whether it's a service or product, requires authentication, whether for a person or an asset or a document, right? We have to authenticate if this person is really, if is really the right person. We have to authenticate the asset, whether they have the asset, whether the asset is valid, it's not a fraud. You have to authenticate the documentation. We always have, there's a process of authentication before we transact. And after we authenticate that, yes, this person A who claimed that they're John is really John, and we authenticate, and the asset, yeah, they do have the asset, and the asset is real and not a fraud, and they really own that asset and they can transfer it. So all of this information, we always have the authentication. We have this authentication that what we call today off-chain, in the physical world. And now all this off-chain authentication now has to be brought to the digital world, what we call on-chain. And without authentication, ownership cannot be transferred, right? I mean, this is how things happen. So the NFTs allows you, and that's the manpower of NFTs, to bring this off-chain authentication process on-chain, and that's the manpower of it. And once you authenticate everything, then you can verify and transfer. Ownership can be verified and transferred and attained, and you can, all transactions can happen. So that can create new opportunities in the future, new assets, whether they're digital or virtual, or digital representation of physical asset. They can have a digital representation of real estate or a Gucci bag. And then, the next step will be the fractionalization ownership that will, of course, increase market share and value. So if we think about beyond art, business use cases, even within the art space, you can create new income streams. And if you think beyond that, then you can NFT a real estate, whether you can real estate, so land deed, the title, and documentation, you can verify the ownership of this asset. and that will and everything is since we're talking about the blockchain, everything will be transferable, trackable, and transparent, and that of course will reduce time and cost. And of course, and this is for the finance people in this crowd, you can even NFT a fund, because if you think about every fund, whether it's an ETF or mutual fund or hedge fund, it's also unique. So think about, in a way that you can actually NFT a fund. There is a way to do that. Maybe that's for a different lecture, but that's another thing to think about. And the ultimate goal, the ultimate vision that I have is basically to NFT is a digital identity, your personal identity, because everything that we do in a digital world and the physical world, can be it will be our digital identity, and that will be NFT'd and authenticated because we are authenticating ourselves. And I guess with that, I'll end here, and I'll open it for questions.
Thank you so much, Dr. Ozier. A couple of questions here, if we can answer them very quickly before we move on to our debate. We've had a slight change in the schedule. We're going to have the panel discussion next, and we're going to have the debate after that. But a technical problem there in David Shapiro joining us from New York. Okay, Dr. Ozier, here's a question. Which company or brand do you believe are creating awesome NFTs?
What I mean, do you mean about the platforms, or which platform or brand?
Yes, I mean, I guess this is such a new space, and as a journalist, I've had a few people write to me and say, "How do I?" I've got an idea for an NFT. One of them being a wine company based in the Cape Town area. How do I create an NFT for my very, very best wines? And of course, there are people now who are doing development, blockchain development for that kind of thing. But the ability to take something like wine, tokenize it, and then be able to sell that on chain somewhere. Just maybe explain that process.
Okay, so you have to understand, wine is unique, right? You have different wineries. Each and every winery is unique. And each and every bottle of wine, it depends on the vintage, right? If it's from 1920 or 1980. So there are all kinds, and some people do collect wine just for this uniqueness. So, and I do know people who do collect wine. So you can think about it now that you can authenticate, right? NFT that wine. I mean, the bottle can still be physical, but the authentication is a certificate for that wine. It's not that the wine is going to be, let's say, the wine itself is going to be NFT, and you just buying, a digital wine. You buying the certificate for the authentication of that wine, that it's really came from that brand, from that winery, whether in Italy or France or wherever, that sold for hundreds of dollars, sometimes even thousands, and it comes from that particular vintage. So as I said, the power of the NFTs is the authentication, and then the power of blockchain is that you can trace each and every bottle, where it is, who holds it, and there are ways, to track it and see where it is even in the world. This bottle of wine that traveled from Italy, maybe now it is in Hong Kong, and who holds that wine. So, and that unique authentication can be tracked and traced, and you have the certificate for that particular bottle of wine.
All right, Dr. Ozier, thank you so much for that presentation. I think that demystified for me a lot of the issues around non-fungible tokens. It really is the birth of something quite new and fascinating, because they're marketplaces for all sorts of things which had no value prior to now. People who develop digital art, people who, like winemakers, who now want to be able to sell the very best bottles of wine that they had for the last season Journalists even will be able to sell stories.
Yes.
People who make video content.
Yes.
You know, there's a value, even though these things can be seen millions of times, the ownership of that, the ownership
Exactly.
of the title deed to that now has value.
Right, exactly. So what it means is, suppose you as a journalist, you post your article. Nowadays, when you post it, basically everyone can copy it. You can't really, claim, hey, but this is me. I was here first, because you can, but it's hard once you put it out there. But with NFT, the whole idea of authentication, even before you post, you NFT it, and then you create this authentication. This is yours. There's a timestamp, who created it, and now you can monetize it right away and make sure that this is your article. You are the original creator, and you should be monetized and get the royalties. If anyone, you can do a click. I mean, this is something that I'm working on, and I'd be more than happy to speak with people about what I'm building right now and developing, that you can create click for view, that everyone who sees your article and read whatever you put out there with a podcast or an article, then they can be monetized for the creation that you have created as a journalist or an artist or any creator.
Okay, we're going to leave it there. Dr. Azair, anybody who's got questions for Dr. Azair can send them through on the Q&A chat line here, or write to Geltec, info@geltec.co.za afterwards, and we will pass it on to Dr. Azair, and I'm sure she will very kindly respond to anybody who's got questions. Thank you very much, Dr. Azair, who's joining us, I believe, from New York.
Right. Yes.
Okay, and very early in the morning.
Yes, indeed.
Well, thank you so much for that.
You're welcome.
Okay. All right. So we're going to go on to our panel discussion now. As I said, we have to move around some of the events here. The debate between Ran Neuner and David Shapiro. We've got a bit of problem with David joining online from also New York. But we're sorting that out. So let's move on to the panel discussion. And these are the tough questions relating to cryptocurrencies. So our panel, let's introduce our panel. We've got Gaurav Nair. We had Gaurav on a little while ago. Marius Rates. Marius, are you there? Somewhere around. Okay, we've got Brenton Nyker from Binance with his lovely Binance slogan there in the background. Hello, Brenton. How are you?
It's very well, thanks.
Good, we're hearing you fine. And we got Ran Neuner as well. Hello, Ran. How are you?
How are you?
Okay, Ran, you're going to be on for a while because you're going to be debating David in a short while about whether we should be investing in cryptos. And if I'm not mistaken, you're on the side of, yes, we should be investing in cryptos as an investment.
No, I mean, I think it's a terrible idea to invest in cryptocurrencies, especially for those people who don't want to make money. I think it's a terrible idea.
Okay. We'll get into that. Okay, Ran, thanks so much for joining us. Ran is a serial entrepreneur, and he's also a very well-known broadcaster in the space of cryptocurrencies. There's a slot on CNBC, which I think maybe you've now gone into YouTubing, and you're building up kind of the Bloomberg of the crypto broadcasting world, where you're going to have a 24/7 channel. So maybe you'll explain that in a little bit to us.
Yeah, I mean, right now, today in the financial system, traditional financial system, if you want to watch or catch up on the news, you would select CNBC or you'd select Bloomberg, and within half an hour, you'd know exactly what's going on in the markets. But if you want the same thing for crypto, it doesn't exist. And so what we're building is we're building a parallel to CNBC or Bloomberg, but it's strictly for crypto. So it's 24/7, 365, streaming credible crypto content, which is accompanied by an amazing website that's full of resources and news and research. And we also, because we understand how intimidating the space is, we also launching a crypto school, it's a free school for anyone who wants to attend. And it really takes you from not knowing anything about crypto right through to being able to build your first portfolio. That's the first stream of our school. The second stream of our school is for people who want to make a living out of crypto, how to trade, how to invest, how to read the fundamentals, how to understand tokenomics, charting, all that kind of stuff. And the third stream of our school is crypto for institutions. How do you accept crypto? How do you reward your customers with crypto? Where do you store the crypto? How do you cash the crypto out? What are the tax implications? So that's the third stream of our school. Everything we do at Crypto Banter is free, and school is free, just like everything else. And our objective is to put 1 million people through school by the end of next year.
Wow. Wow, fantastic. Okay, I mean, a couple of questions that are coming in here. So I think if I can ask you to keep your answers fairly brief, and we'll rattle through as many as we can. Gaurav, I'm going to start with you. And the question is, you did kind of address this in your presentation, is if people are investing in crypto, what is a good way to start, and how much of their portfolio should be in crypto?
Okay. Well, I guess I have to put, my head of compliance will kill me that I can't give financial advice here. But, you know, I think that example I showed is one where you take a portion of the portfolio, and that portion was something which you're not looking for immediate liquidity. The reason being that whenever, and this will vary for some people. For some people, you know, that could be a high number. For some people, it could be a very low number. Some people, they need their whole portfolio to be liquid because they might need it for expenses that are coming up. And the reason being that the very famous volatility of cryptocurrencies. While a lot of us probably on this panel are very confident about the medium to long-term trajectory of cryptocurrencies for many reasons, whether it's the technology or the asset status or the supply and demand dynamics, I can't tell you what the price is going to be tomorrow. And I can't tell you what the price is going to be a few months from now. So it needs to be a part of your portfolio that you're willing to hold for a medium to long term, because you don't want to be forced to liquidate it when when the price is down. That being said, I don't want to give the impression that it isn't liquid. It's obviously very highly liquid. It's just the volatility that you're controlling for here.
Great. And by the way, Marius joined us there while we were going through the introductions. Welcome, Marius, who for people who weren't here for his earlier presentation is the General Manager for Africa for Luno, and he's wearing his T-shirt there, his Luno T-shirt, so you can't mistake him. Oh, and Brandon Scott.
If everyone's going to wear swag,
I don't know what that is. I don't know what that's your face, right?
Yeah, me full of crypto.
Brenton, if you can pick up the same thing. And again, sorry, just to preface this and say, none of our speakers here are giving any advice. These are opinions. What should people be? How should they regard crypto investments? How much of their portfolio? You get a sense that people in the crypto space, they're a little bit apologetic. It's so volatile. It's so risky that but yet people like Ran and others, Brenton and Marius as well, I guess. You're probably all in on crypto. You're much more than the 2% asymmetric upside that you talk about to the more conservative crowds. I know it. But Brenton, I want to hear your opinion about that.
So, again, I think just to reiterate what Gaurav said, I think that on an individual perspective, it boils down to that individual's needs, everything from their risk appetite to their current age, what is their investment horizon. But I think what's great about the cryptocurrency sector is that those very, very low barriers to entry allow everybody to essentially make that same decision, right? So I can't tell you whether, your portfolio allocation should be at 2%, at 10%. But the great thing is if your net worth is 1,000 Rand or your net worth is 1 million Rand or 100 million Rand, you can still effectively make that same allocation and enjoy the same upside as any other investor in the space. And I think we know at Binance, we try not to dictate to the end users what they should do, but rather provide them with a suite of products that allows them wherever they are in the scale to really be able to access the market and utilize it the way they want. So, like I think some of our other speakers mentioned, if you're a little bit lower on risk appetite, you're a bit of a buy and hold type person, it's simple to go and make a small allocation to Bitcoin. Again, like where I've said, personally, I think you should be making the investment for the medium to long term. But there's also a whole bunch of young people whose risk appetite are far off what our traditional investors look like, right? So they're happy to throw $100 into some of these small cap alts. They're happy to use what some would call very, very dangerous levels of leverage on derivatives markets. So I think the key with the crypto market sector is for people to really understand what the pros and cons are of each sort of product set. And then based on that, and knowing who you are as a person, what your risk appetite, etc., is, you'll be able to then utilize whichever product set you see fit. So from an investor perspective, and again, I'm going to disclaim here that this is my own personal opinion, not in any way affiliated to Binance. I do think that it is just quite advisable from an investment theory perspective to have some sort of allocation in your portfolio to cryptocurrency. And,
right.
Your more traditional large cap ones. But if you want to get a little, there are product sets in education on Binance that allow you to, whet your risk appetite a little bit more than most people would, I think, dare.
It's at the Binance Academy, right?
Correct. And the platform as well, choked full of educational material.
Yeah. Ran, if you can pick up that question, if I can modify it slightly for you, I think most people's point of entry into the crypto space, they buy a bit of Bitcoin and then they follow that up with Ethereum. Why do they pick those two? Because those are the two biggest in terms of market cap. But I think you have a slightly more logical and systematic way of going about this. And you're a trained certified financial analyst, so you come at this with a certain amount of logic and investment background.
So I think I agree with both the previous speakers to say that it's a very small part of your portfolio. No matter how optimistic you are about crypto, crypto should, at this stage of the game, make up a very small part of your portfolio. And the reason for that is that it is a speculative asset. It's less speculative than it was 10 years ago, but it is still in the more speculative part of your portfolio. Now, once you've decided what your asset allocation is, whether it's 1% of your investable assets, 5%, or maybe at a stretch, 10%, then the idea is to decide which networks you want to invest in. Now, ultimately, when you're investing in crypto, what you're investing in networks. And it baffles my mind why some people say, should I buy Bitcoin or Ethereum? Because that's like saying, should I buy gold or Amazon? One is a store of value, and the other one is a supercomputing network. And so ultimately, the approach that I would take is to say, either buy a balanced index portfolio of cryptos, and get exposure to multiple industries that cryptocurrencies are going to disrupt, such as gold, such as supercomputing, such as file storage, such as banking. So that's one approach. Or start selecting assets, but then you really got to know what you're talking about. You got to know the fundamentals, and you got to have a thesis and stuff like that. But it's certainly not one or the other. It's certainly a diversified portfolio across the entire crypto universe.
Mario, same question for you. How do people typically start at Luno? And of course, Luno was very focused when it started out. You offered Bitcoin initially, and then you expanded it out to Ethereum, and now you've got a few other coins, but you weren't offering, like Binance is, this huge range of different cryptocurrencies. You were very focused. And maybe explain why you did that.
Dr. I think no quick scheme. No, I know this is an investment conference, but there's no silver bullet coin that if you own this coin, you're going to 10x your investment in the next 2 years. People want short-term gains, and they become greedy. They think crypto is going to provide them with that type of return. So that's the first thing. The price isn't guaranteed to only go up. The price will come down, and we've seen that many times in the past. So if you don't own cryptocurrency currently, but you're interested, then you've got a bit of homework to do. I think the fact that you attending this conference is a good start. So thanks to everyone for making this possible. But you first really need to do a bit of basic understanding. And there's this unwritten rule that you need to spend hours on a topic, to understand it before you decide to allocate any funds or invest in 1,000 hours a lot, and maybe have 1,000 hours at hand, and you can just to understand the basics around why we all get excited about crypto, and especially Bitcoin. what are the main features, what are the risks. So I think that's a good point. But you have to find a safe platform. So with a bit of research, I think on Google, you should be able to find a crypto platform where you can safely convert your ZAR to cryptocurrencies. And you can start with, most platforms, 1 to 10 Rand. You don't have to start by investing your bonus into crypto. So on Luna, we're actually seeing most people, I think the average first deposit or the first buy transaction size is under 1,000 Rand. So most people start small. They start using 1,000 Rand. And once they're comfortable with how everything works, how it works, the processes and the different products, then they've got a bit more confidence and comfort to actually do more. And a lot of people, clients, the Rand cost averaging method, where on a monthly basis, and we see that literally on the 25th of each month, people set up the recurring payments and deposits and buy a little bit of on a monthly basis. And that way, over time, they average out the volatility, which is obviously very prevalent in the crypto market. So I think if you don't own crypto currently, you need to start doing research. Obviously, secondly, from a safe platform, and thirdly, and gradually, as you gain more comfort, you can start to increase. But obviously, having said all of that, you first need to look at your budget and your expenses, and only once you've paid school fees and even paid pension, and you've got funds left, that if you're new to crypto, then put it into or cryptocurrencies.
Okay, the next question is about crypto scams. How do you spot one? Broad question, if you can give us your quick answer to that. Gaurav, if we can start with you.
Sure thing. I guess one of the ways that kind of raises my flags is I look at the history of the provider. If the person that's now providing this investment opportunity or whatever it is doesn't have much history, is maybe crypto only. Some of the guys that are offering financial products, they claim to be crypto only, and they've got no track record of ever having done anything in any other space. That's obviously excluding Binance and Luna, who are also then very well known. They didn't just appear out of nowhere. They're very well known. And so if it looks like a small shop, not much presence on the internet, no history, then I immediately start getting suspicious to begin with. And then a lot of questions. So don't be afraid of knowledge that you should have. Anything that doesn't make sense to you, just ask lots of questions, and very quickly you'll start to see that the answers don't add up. So that would be my recommendation.
All right, Brenton, you want to add something to that, please?
Yeah, so just a little foray before we get into some of the red flags. I think people tend to, and I think in South Africa it's a bit unfortunate. I mean, we all know the history of the scams here. People have this negative connotation attached to cryptocurrency and scams, but I think it's no different to the general sort of Andy, right? So it's just the new hot thing at the moment. Previously, we saw it quite prevalent in the Forex sector. But I think one thing that's quite common across both those sort of scam environments, as well as those in cryptos, and particularly in crypto, your biggest red flag is when you get a guaranteed return. So nowhere in any market, other than your sort of fixed rate products, will you get guaranteed returns. So that is your first red flag. And I think, secondly, there's a lot of common traits. So you get things like guaranteed returns, like Gaurav mentioned. They're usually quite resistant to questions. They've got no track record within any sort of financial industry space, any crypto asset space. So there's a number of red flags, but I think the top one is like celebrity endorsements, very, very high guaranteed returns. Those are probably the two prevalent red flags. I mean, on Binance Academy, we have a few more, but my general advice is as soon as you see the word guaranteed return, just turn the other way and run.
Good. Rand, can you add something to that?
Yeah, very quickly. I mean, I think the underlying premise for me is anything that seems too good to be true is too good to be true, and especially when it comes to crypto. So if I looked at MTI and all these other scams that happened, when I looked at them on face value, these fund managers were purporting to be reporting returns better than the average or the best VC funds out there. And I'd never heard of these guys. I'd never seen any of the on-chain transactions. So I think the underlying premise is, if in crypto specifically, if it seems too good to be true, it definitely is too good to be true. Also, because crypto is a little bit more complicated than, say, buying art or buying a property, it's a little bit more complicated because there's technology involved. People take advantage of people's fear of the technology. So, they'll give you a technical line, something like we mine using 5,000 exahashes or whatever, something stupid. And then the average person looks at this and doesn't understand it, and therefore thinks, okay, I can invest in it. The idea is you've got to do your own research. It's like everything else in the world. If you don't do your own research, you do risk actually getting scammed. That's the basic scams. The second part of the scam, the second part of these the scams is, because there's so much money flowing into crypto, and because there's so few regulations, scammers have seen this as an opportunity. There's so few regulations, no one even knows where crypto is regulated. If you get an SMS that comes from somewhere that points you to a exchange account and you put your name and your password, where does that get? Which police should you report it to? Where are they going to find these people? So I think that, unfortunately, because of the global nature of crypto, and because it's so complicated, and because it's so new, and because there's so much money flowing into it, the scammers have seen crypto as an easy place to attack. And there are huge returns. If I have 1 second, I'll give you a very common scam that's actually happened to me. So on Instagram, they create a profile they copy all my photos with my profile picture, and then they name themselves Crypto Man Run, which they can do because there's no limitations. And then what they do is they get a list of all my friends, and they message them. And my friends think it's me messaging them. And they eventually ask them for money. And some of my friends have actually given them money. In fact, we know of about $1 million that was sent to these scammers just trolling through my Instagram account from fake accounts. So scams are real, and regulation can't come quickly enough, but it is quite a complicated space to regulate.
So Ran, if I can just jump in there quickly, I did a tweet about the panel just before this, and I tagged you, and the first comment there was from a scammer who'd named himself Crypto Man Ran. It's definitely something that we can see.
The thing that upsets me the most is that they are able to raise more money than I'm able to raise, which is strange. I'm kidding.
Yeah. I mean, I've actually trolled some of these guys, these scammers, and one of the tricks that they do is, I see Marius has gone offline. I was going to ask him the next question. One of the tricks that they do is to offer you a return, and I think you've all mentioned that, this sort of guaranteed return. We're going to double your money for you, and it's going to take 6 weeks or whatever. And you'll do a small transaction, and they actually will show you a profit. But that is really the come on for the bigger hit. And they're going to come back at you and say, okay, now let's go for round number 2. This time do 100,000. And I actually came across somebody in Durban, this, working class lady, nurse in one of the hospitals. She went and got a personal loan for 120,000 Rand and sent it off to this scammer. And then, when her profit fell due, then came the next part of it. You've got to now send tax. You've got to pay tax. Well, this guy is not collecting tax on behalf of South African Revenue Services. That's for sure. That's a scam. And the next thing is, there's going to be a release charge. So they start adding all of these additional obstacles and charges to the thing. Marius, if you're there, no, you've gone offline. Okay, so I think, Brenton, if you can pick up that one as well, because I think the exchanges, you're kind of at the front line of handling a lot of this. A lot of the traffic that you're getting is people who have been scammed or who are trying to do scams. How do you stay on top of that?
Absolutely. So personally, I can attest to Binance as a cryptocurrency exchange. Another thing, digressing a bit, but people think crypto is, completely anonymous. We can't track anything. If you look at the on-chain analysis tools that are available at the moment, things like CipherTrace, I can promise you that the provenance of funds is far better on-chain than the current traditional financial system. And what that means is that by utilizing these on-chain tools, Binance as an entity, and there's been news articles about this globally, have one, been able to track down a number of these scammers, follow the flow of funds and freeze those funds and repatriate what we could sort of recover. But two, we've also been able to be proactive in the sense that once we are able to tag these scam addresses, we can actually prevent users from withdrawing funds, or at the very least, provide them an initial verification step to say, hey, this is, a sort of red flagged address. Please be aware that this is what they do. Do you still want to proceed with the withdrawal? Because at the end of the day, we can't. But I think from a proactive sense, that's what Binance is doing because it is so prevalent. But over and above proactive measures, like I said, reactively, we've recently assisted even the South African Revenue Services with a number of on-chain monitoring and sort of tracking down some of these scammers. So I think it's very twofold. Retail users have got to realize that the intricacies of cryptocurrency, right? So never send anyone your crypto because there is no customer service desk that you can phone. There is nobody who can reverse that transaction for you. So I think that's number one, just an important distinction to have. And then number two, I think, because it's so new, it is quite a difficult sector to wrap your head around. I think some of the measures the exchanges like Binance have, for example, have been taking will definitely go a long way in protecting particularly new from getting scammed. So I think it's a sort of two-edged effort. It's got to come from the retail users and the platforms as well to sort of try and keep their own users safe.
All right, Marius, are you hearing us?
Yes, Kieran.
Good. Okay, so I don't know if you heard what we were talking about there while you were offline, but I wanted to throw that same question at you, is how are you helping to track down the scammers? Because I know this is a lot of traffic that is being generated by scammers using exchanges in South Africa for the purchase of Bitcoin and then sending it off to dodgy addresses.
Yeah, Kieran, maybe just taking a step back also, I think, in the minds of the public, crypto is dominated by scams and criminals. And I think, that is, somewhat the case. Yes, we have people operating crypto that will take chances. But if you look at the data analysis, which is the leading crypto analytics company, then you'll see that the number of the percentage of illicit transactions in crypto is less than 1% of transactions. And when compared to the traditional financial system, it's more or less in line. And if we also consider that criminals use messaging applications and tools and chat apps on a daily basis to coordinate attacks, and I think we saw a good example recently with the looting that happened. It was all orchestrated through chat, WhatsApp and other chat channels. But we don't ban those systems because there's a benefit to society at large. So same with crypto. I think one of the tips I can give is whenever someone reaches out to you via social media, walk away. You didn't contact that person first. Why would someone contact you directly on social media to offer to trade on your behalf? So I think immediately from Luna's perspective, we do a lot. We spend a lot of resources, time and energy and money on compliance and making sure we have a safe platform. So a couple of the things we do, obviously from a KYC perspective, I think that's the first step, making sure that you can identify the clients on your platform, on your platform. That's very important. Secondly, more related to scams, is that we use third-party providers that scroll through social media and then take down scam pages. So you have all of these Luna Investments, Luna South Africa, Luna for Beginners, all of these groups on social media with admins that pretend to be Luna employees. So we take on automatically, report them through third-party providers, and then similar to also use third-party providers to identify address. So whenever a customer tries crypto from Luna to one entities, which of MTI was one thing, we prevent our customers from doing that. Now that's completely different to the banking system. Your bank won't ever deny you, sending your rands to another bank account. That won't happen. But we have to do that at this point to safeguard our customers and our clients. As Benton said, that you cannot reverse a Bitcoin transaction once it's processed, it's final. So we give our customers the information that they need to make the final decision and decide to send Luna. So, but this is a big responsibility that sits on all of our shoulders. We can't, as an industry, say, well, be stupid. No, it's our responsibility to ensure that we empower customers with the information that they need in order to make decisions and to decide whether something is a scam or not. So there's a big responsibility on our shoulders to ensure that the initiative is secure.
Okay. All right. We're heading up against the clock, as usual. Thanks for those answers. A question about altcoins. Altcoins, for those who don't know, that's anything other than Bitcoin. It's a crypto other than Bitcoin. Of course, a lot of action. You know, if you're looking for these kind of these coins that grow at 10,000% or whatever ridiculous figure you can imagine, it's that which is attracting the interest of the very, very speculative, high risk end of the investment market. So, Ran, if I can kick off with you. And by the way, there's a question here. Somebody wanted to know, how do they sign up for your crypto school?
So go to the Crypto Banter website. There's a button that says school. Go to school, click on the application form, and just follow the application form. Very simple. So it's cryptobanter.com, and there's a button there that says school applications. Just follow the lead there.
Okay, good. And then onto the altcoins. How do people evaluate that?
Look, it's a skill. It's a skill like, you know, evaluating whether a company is a good company. The only difference is that people have been using and building tools to evaluate or value companies for many, many years. In tokens, it's a little bit different. So I think it's a minefield, and I think unless you're going to get involved in it full time or on a fairly consistent basis, then I think it's very much like throwing darts or following sentiment. So it's not an approach that I like to recommend. I see a lot of people following social sentiment. Chances are, if you're following social sentiment, by the time you're getting it, you're one of the last people to hear about it. And you know what happens. The last person to hear about it is also the last person out of it. Yeah, so I think that, I mean, I don't want to push our channel or stuff like that, but there are many good resources. Find the resources that you like. We have 4 daily shows now. We have 4 hours of daily programming. We cover, you know, we have a technical show in the morning, which is all about charting. We have a fundamental show in the afternoons. We have a show called Microdose, which is a 10-minute, everything that happened on the crypto show in 10 minutes, but with no side effects. And then we have what we call In the Game, which is a show that we're launching today, which is all about which in-game NFT assets people should be buying. So which land in Splinterlands and which Axie in Axie Infinity and which NFTs inside games should people be buying, because it's a whole industry. So we cater for that. We've got a show for that too. Yeah, so I think if you're going to get into altcoins, it's a minefield. 99.9% of them are garbage and will fail. And the skill is to try and find that 0.1% before anybody else does. And that requires lots of hard work and research.
Okay. Gaurav, you want to pick up that altcoins? You've got an index there, and you've selected some altcoins. I think, if I remember correctly, you've got Cardano and Polkadot up there. Maybe explain, if people are going to go that way, then how should they start selecting them?
Yeah, so Kieran, I guess just very much like the traditional sector, there are many approaches to this. And Ram was talking about different shows that potentially take different approaches, charting, fundamentals, etc. I've always personally had a lean towards fundamentals. And so when it comes to this space, there are also fundamentals behind a lot of these altcoins. And so it's very important then to start trying to understand. Now, there is a lot of content out there. So there isn't necessarily a shortage of content if you want to look for it. And so behind all of these coins, there's often technology. And the important thing to understand is how tested and safe is the technology, how much has it been used. Obviously, the more it's being used and the longer it's been around, the less chance that there are security exploits or problems with it that people have not yet found. But nonetheless, there is still that chance. It's kind of famously called the Lindy effect. The longer the more likely it is to still be around. And then understanding what you think are the use cases for this. So kind of lots of people publish use cases, and it needs to make sense to you. If it doesn't make sense to you, then potentially you're not understanding it, but it's safer than not to be in it. If you start to see the use of the technology, how it could improve things, how it could make transactions cheaper or bring new utility to new industries, that's important. And then also what's very important, which we don't necessarily have to worry about as much in the financial sector, in the traditional sector, is something called tokenomics. And tokenomics is how the tokens are issued or burnt, and that being that the tokens cease to exist, and what the plans for that are. That's also very important. And then there are numerous things that are unique to, so all the points I kind of raised above are actually quite relevant to any investment. And then there are things that are unique to cryptocurrencies. So how centralized is the supply? Because that means that people can change it. Are there admin keys? Again, that involves a few people having control and being able to take all the money that's invested in a protocol. So there isn't a shortage of content, but I would say don't venture into something without doing a lot of research and understanding every facet of it that you can.
Okay, I think also on the altcoin side, Brenton, I want you to come in on that, and then Marius, and we're going to have to wrap it up there. But looking at the business case, it's very difficult in cryptos because we're at the birth of something. We don't have a 20-year track record to measure what the income stream is. So you're really making a guess. If you're betting on Cardano being, as they say, the Ethereum killer, you're betting on it actually making a huge amount of revenue going forward. And that's a little bit of an impossibility to know at this point. But Brenton, give us your thoughts on this.
So interestingly enough, from a personal perspective, before I discovered crypto and went down the rabbit hole, I was I was a quant and a bit of a hobby data scientist. So I actually have extensive models around valuation. So, there's, like Rand said, if you're not going to get into this full time, please don't go too deep, because everything from the tokenomics, which sort of relies on a fair understanding of game theory within economics, how incentive structures are sort of put together, sort of played out within the networks. But I do think sometimes people try to create too much of a disconnect. So, one of our speakers mentioned storage, right? So that's something we all understand. So in terms of going to an addressable market, what is the size of AWS's current storage business? Does this protocol offer any competitive advantages to Amazon, right? So there we've got a starting point in that if Amazon storage business is a $300 billion annual industry growing at 10% a year, we've got suddenly an addressable market for what this token could then, accrue in value. And then when you start looking at how many tokens they are, it gives you an indication of what the potential price could be. I forgot to mention, this is not financial advice, but I think, it is quite difficult for the average person to do that, which is why, Binance Academy, for example, I think first from a listing perspective, people know Binance for all the altcoins we have. But interestingly enough, less than 2% of tokens that apply to Binance actually get listed. So they all go through a rigorous vetting process. So Binance does that due diligence of making sure it's a legitimate project. They've got a team that, the code is up to scratch, which means that you're already looking at, when you log on to Binance, quite a high quality, so to speak, selection of assets. And then if you go further into Binance Academy and Binance Research, they've sort of condensed all this information that you need to know, tokenomics, the track record of the founders and things like that, all into very nice readable articles. So it does give you that start in terms of understanding what the project is, what it does, who the founders are. But I think I'll just end off with one thing that I've found, again, personally, to be the most indicative of early stage project success. And that has really been the team behind it. So if you see a project with an all-star team, meaning, they've got a high degree of corporate expertise in, if you're going into storage, ideally you want somebody who has a background in the storage space, quite a number of credentials. So that is something that I think we grasp a lot easier, right? If there's somebody with a PhD in, networking protocols and they've developed something, it's highly probable that it's of value. Whereas if you have some random teenager in their basement, launching a coin and hyping it out, it's far less likely that there is some value contained within that project. So I think, yeah, that's it from my side on altcoins.
Okay. And yeah, exactly. What's the track record of the people? You know, can you check them out? Do they have offices? Do they have a phone number? You know, does the website have misspelling and bad grammar? You know, is it a Google Translate thing? These are just very, very quick and dirty kind of checks that you can do on something. Gentlemen, thank you very much for that. We're going to leave it there. We're going to take a 10-minute break. There are some other questions here. For example, people are asking questions like the charitable remainder trust. Will these be available in South Africa as they are in the US? I don't know if any of you are able to answer that, but there are some other questions. So if we go to the breakaway rooms, the sessions there on the left-hand side, 10 minutes. And then we're going to come back for the debate between Rand Neuner and David Shapiro. This is the heavyweight title bout between two of the greatest sluggers in the history of crypto.
No pressure. See you later.
Right.
Nice. Cheers, everyone.